Please like, share, and subscribe. Wishing you happiness and good luck every day.
What if you could navigate all the turbulence in the market, not by trying to predict the future, but just by, really understanding the present? Well, that's the powerful skill we're diving into today, mastering the market cycle. It's honestly one of the most crucial tools for any serious investor. So let's get right into it.
And our guide for this journey is the Introduction to Mastering the Market Cycle by the legend himself, Howard Marks. We're talking about the co-founder of Oaktree Capital Management and really one of the most respected voices in the entire investment world. And look, to really get a sense of the weight of these ideas, just consider this endorsement. When Warren Buffett, arguably the greatest investor of all time, says he stops everything he's doing to read someone's thoughts, well, that's a pretty clear signal, right? It means the insights we're about to cover really demand our full attention.
So yeah, that endorsement isn't just some nice praise, it's a promise of value. It's basically confirming that what we're about to explore isn't just some abstract theory. No, these are practical, essential tools, straight from the playbook of the world's most successful investors.
And it's not just other people saying this. Howard Marks himself puts this skill on a pedestal. He's already written about the most important things in investing, and he says that understanding cycles is, and I quote, very near the top of the list. So let's be super clear. This isn't just one more tool in the toolbox, it's a foundational pillar for success.
Okay, so why dedicate so much focus to cycles? Why all the fuss? Well, it's because they help us bring order to what often feels like complete and utter chaos in the market. They give us a framework, a way to understand the ups and downs that can otherwise feel totally random and unpredictable.
I mean, think about it for a second. Have you ever been caught completely off guard by a market swing? It's such a common, frustrating feeling for so many of us. The study of cycles, well, that's the antidote to being constantly surprised. The real secret here is that recognizing patterns isn't some specialized financial skill you have to learn from scratch. It's actually something we all do, instinctively, every single day of our lives. You could say we're basically hardwired to be cycle detectors. Seriously, think about it. We instinctively plan ski trips for the winter and beach days for the summer. We know when to avoid certain places during hurricane season. We pull our warm coats out of storage not because we're surprised by the cold, but because we're anticipating it. We're constantly using these predictable patterns to our advantage, and we often don't even give it a second thought. And this, right here, is the core idea for Marks. That very same logic applies directly to the financial world. Economies, companies, entire markets, they also move in patterns. Now, they might not be as rigid as the four seasons, but trust me, the patterns are there if you just know how to look for them.
But, and this is a really critical difference, look at this comparison. Natural cycles, like the seasons or day and night, they're based on physics. They're regular, they're highly predictable. Market cycles, on the other hand, are driven by something way more volatile, human psychology. And that's what makes them irregular, but still recognizable. And that right there is the big payoff. By studying these patterns and really understanding what causes them, especially that psychological part, we arm ourselves. We're no longer just reacting to the latest market news. We have a context for it, and that dramatically reduces the chance of being blindsided.
Okay, so if human psychology is the engine driving all this, what does that engine look like in motion? Well, Marx gives us this powerful metaphor, a pendulum, one that's constantly swinging from one extreme to the other. You see, the secret to the market isn't some super complex algorithm. It's understanding people. The market cycle is literally a reflection of our collective human emotion, swinging from greed to fear, from euphoria all the way down to depression, from being eager to take on risk to desperately wanting to avoid it.
And Marx really doubles down on this point. He says because people are involved, you can't time these cycles with a stopwatch. They're not going to repeat perfectly. But the themes, the emotional drivers, and the general patterns, oh yeah, they come back again and again and again. And this is where we get to the good part, turning that knowledge into an actual advantage. See, the goal isn't just to stand on the shore and watch the waves crash, it's to learn how to surf them. By understanding these patterns, we can position ourselves to ride the momentum instead of getting pulled under by the current. All right, this next part might just be the most important piece of the entire puzzle. It's the difference between knowing something and actually doing something about it.
You see, he says his number one message is that we have to listen to the cycles. But what does listen really mean here? because that phrase has two very, very different meanings, and understanding the distinction is everything.
Well, there's the first definition, the passive one, to simply hear. It's like acknowledging information without really letting it sink in. You know, you might see a report that says market optimism is at a fever pitch. You register the fact, and then you do absolutely nothing.
But then there's the second definition, to heed, and this is the one that changes the game. It means to absorb the lesson, to be guided by it, to let it actually change your behavior. It's the difference between hearing the weather forecast for a hurricane and actually boarding up your windows.
Just look at these words. This is basically a list of all the ways investors fail: to ignore the warning signs, to disregard historical patterns, to discount high valuations because of that seductive, dangerous belief that this time is different. This is the language of not heeding, and it is a recipe for disaster.
And Marx doesn't pull any punches here about what's at stake. He uses the word invariably. Ignoring where we are in a cycle isn't some neutral act. It's a decision that sooner or later leads to some really painful consequences.
So the big question is, how do we actually get good at this? How do we build that muscle so that we don't just listen, but we actually heed? Well, Marx provides a roadmap, a way to develop a winning investment philosophy.
Marx lays out this fantastic 5-part philosophy, and every single piece is critical. First up, you've got the foundation. You just have to do the work. You need the technical skills in accounting, finance, and economics. That's the price of admission. Second, perspective. You can't just borrow someone else's opinion. You have to develop and constantly refine your own view on how markets really work. Third is curiosity. You have to read broadly. The best insights often come from way outside the narrow world of finance. History, psychology, science, they all give you new mental models for understanding cycles. Number 4, collaboration. This is not a solo sport. You have to exchange ideas, talk to people who disagree with you, and let your best ideas get challenged. That's how they get stronger. And finally, number 5 is wisdom. Marx is so clear on this. There is no substitute for experience. Every single cycle you live through, the booms and the busts, is an invaluable lesson that no book can ever fully teach you.
So, all of this leaves us with one huge, crucial, final question. If these incredibly powerful cycles are truly governed by that great pendulum of human emotion swinging between euphoria and despair, then the most important thing we can ask ourselves is simple. Where are we on that pendulum right now? Answering that one question, honestly, is the essential first step toward mastering the market cycle.
You know, we're all searching for that secret sauce in investing, right? That little trick that lets us see what's coming next. But what if I told you the best investors, well, they aren't fortune tellers? What if their real superpower comes from understanding what's happening right now? Today, we're going to dig into the wisdom of investing legend Howard Marks to figure out how to stop predicting and start preparing, all by understanding market cycles.
It's really the million-dollar question, isn't it? How do a handful of people seem to beat the market, not just once, but year in and year out? It's definitely not luck. So, what is it? What's their secret? How do they do what feels almost impossible for the rest of us?
I think the first place our minds go is, well, they must be geniuses at forecasting the economy, right? They must have some crystal ball that tells them exactly where interest rates are going, what GDP is going to be, all of it. And look, it seems logical, but it turns out that's a path that leads most people to disaster, not to riches.
Howard Marks often brings up this incredible mental filter from Warren Buffett. For any piece of info to be useful, it needs to clear 2 hurdles. It has to be important, yes, but it also has to be knowable. And that's the big trap. Of course, the future of the economy is important, but is it really truly knowable? Can you consistently know it better than the millions of other brilliant people trying to do the exact same thing? For pretty much everyone, the answer is a big fat no.
So here's our game plan for how we're going to completely rewire our approach. First, we're going to tear down this whole myth of forecasting. Then we'll build something much better in its place. Thinking in tendencies. We'll see what a real knowledge advantage looks like, compare how average and superior investors think, and then, this is the really cool part, we'll visualize how cycles literally shift your odds of success. It all leads to one simple idea: preparation, not prediction.
All right, let's kick things off by just dismantling this idea that you need a crystal ball to win at investing. I mean, sure, the macroeconomy is the stage where everything happens, but trying to guess its next move, that's a game that very, very few people can win consistently.
And let's be super clear here. This doesn't mean the macroeconomic doesn't matter. Oh, it matters a ton. The problem is, it's just not knowable in a way that gives you an edge. Think about it. To outperform everyone else, you have to know something that the consensus doesn't. But when millions of really smart people are all staring at the exact same data, well, getting a consistent forecasting edge is next to impossible.
Okay, so if we're not supposed to be economic fortune tellers, what should we be doing with our time and energy? Well, Marx says we should pour all of it into the things that are knowable. Number one, deeply understanding the fundamentals of a specific company or an industry. Two, having an ironclad discipline around the price you pay for something. And three, which is our big focus today, getting really good at understanding the current investment environment and figuring out where we stand in its cycles.
This brings us to a huge, fundamental shift in your mindset. It's really about leaving that black and white world of predictions and certainties behind and instead embracing the much more powerful and realistic world of probabilities and tendencies.
So, what the heck is a tendency anyway? The best way to think about it is that the future isn't a single dot on a map. It's more like a cloud of possibilities. Instead of trying to pinpoint that one single dot, your job is to understand the shape and density of the cloud. You stop asking what will happen, and you start asking, okay, what's the range of things that could happen here? What's more likely and what's less likely? It is a total game changer.
This quote from Elroy Dimson just nails it. For any event in the future, there are dozens, maybe hundreds of different ways it could play out, but only one of them is actually going to happen. And that gap, that space between all the things that can happen and the one thing that will happen, that's where risk and uncertainty live. The best investors don't try to guess that one outcome. They position themselves to do well across a whole range of the most probable outcomes.
Okay, I get it. This whole idea of probability might still feel a little abstract, a little up in the air. So let's make it super concrete with a simple, brilliant analogy that Howard Marks uses all the time to explain what a real investment edge actually looks like.
Okay, picture two big glass jars filled with balls. Jar A is a total guessing game. It's got 50 black balls and 50 white balls. If you have to bet on which color gets pulled out next, it's a coin flip. You have zero edge. But now look over at jar B. This one has 70 black balls and only 30 white ones. Now, is the outcome certain? No way. You could absolutely pull a white ball. But the odds are not 50-50 anymore. Not even close.
I mean, it's obvious, right? It's a no-brainer. You'd play the game with jar B all day, every day. You don't know for sure what the next ball will be, but you have a powerful insight into the tendencies. You know that if you just keep betting on black, over the long haul, you're going to come out a winner.
And that right there, that is the heart of a true knowledge advantage in investing. It's not about owning a crystal ball. It's about having a better feel than most other people for what's inside the jar, for the underlying probabilities that are really driving the market. It's about knowing if the odds are in your favor, if they're against you, or if it's just a coin flip.
So how does this actually play out in the real world? Well, this one little difference in mindset, knowing the odds versus just guessing, it creates a massive gap between the average investor and the superior one. Let's break down how they each operate. The average investor gets whipsawed by the daily headlines, right? They see every move in the market as some random, isolated thing. They get giddy and euphoric at the top of a bubble, and they totally panic and sell at the bottom of a crash. The superior investor, though, they're more like a student of history. They see today's news not as something new, but as just another verse in a song they've heard many times before. They recognize these recurring patterns of human behavior and market psychology, and they know that where we are in that pattern has huge implications for what they should be doing next. So what does this actually look like day to day? Well, a superior investor is constantly playing detective, always asking these kinds of diagnostic questions. They're taking the temperature of the market. Is the main emotion out there greed, or is it fear? Are people being appropriately cautious, or are they throwing caution to the wind? Are things generally overpriced, or are they cheap? And the answers to those questions tell them everything they need to know about whether it's time to play offense or time to play defense. Now we get to the most powerful part of this whole idea. Let's actually visualize what it means when we say that our position in the cycle shifts the odds. This is where this abstract concept becomes a real tangible advantage you can use. So let's start with our baseline. In a totally neutral, plain vanilla market, the range of possible future returns looks something like this, a standard bell curve. The most likely outcome is smack dab in the middle, with a pretty balanced chance of doing a little better or a little worse. There's no real edge, no real disadvantage. The jar is 50-50.
But now, look what happens when we find ourselves in a favorable part of the cycle. I'm talking about the depths of a recession, when fear is everywhere and assets are on sale. The entire probability curve shifts to the right. The most likely outcome is now a much higher return. But even more importantly, the chance of a really fantastic outcome goes way up, and the risk of a big loss shrinks. You haven't predicted the future, but you have tilted the odds massively in your favor.
And here's the flip side, and you could argue this is even more important to understand. Think about the peak of a bubble. Greed is the only emotion in the air. Prices are in the stratosphere. The entire curve shifts to the left. Now, the chance of losing money is dramatically higher, and the potential for big gains is way, way smaller. A smart investor sees this shift and knows, okay, time to get defensive, because the game is now rigged against them.
So this all brings us to the ultimate conclusion, the core takeaway from Howard Marks's entire philosophy on cycles. And it's a really simple idea, but it's also incredibly profound.
After all of this, what's the actual goal here? It's not about calling the exact top or bottom of the market. It's not about having a magic 8-ball that tells you next quarter's earnings. Everything we've just talked about, the cycles, the psychology, the odds, it all just boils down to helping you answer one simple, powerful question.
And that question is, where do we stand today? The real job of a superior investor isn't to predict the future. It's to rigorously and honestly assess the present. Because if you know where you are in the cycle, that tells you almost everything you need to know about the odds. Are they in your favor, or are they stacked against you? Answering that question, well, that's the only prediction that truly matters.
Hey everyone, and welcome. Today, we're jumping headfirst into a really powerful idea from Howard Marks's book, Mastering the Market Cycle. We're not just going to look at the ups and downs of markets as some random pattern. No, we're going to see them for what they really are, a system, an interconnected chain where every single event literally causes the next one. Let's get into it. Okay, this quote right here, this is everything. It's the single most important idea we're going to talk about today, and it will completely change how you see things. You know, most people see a boom, and then they see a bust, and they just think, well, one came after the other. But what Marks is saying is so much deeper. He's saying the boom itself, all that optimism, all the crazy risk-taking, that's the very thing that builds the bomb that eventually goes off. It is a chain reaction. And once you get that, everything starts to make sense. So here's our game plan. First, we'll really unpack that idea of a causal chain reaction. Then we're going to dissect the anatomy of a cycle, literally break it down piece by piece. After that, we'll look at the psychological engine that drives the whole thing, figure out why history seems to rhyme, and then wrap up with some timeless truths that you can take with you. All right, section 1, a causal chain reaction. This is where we shift our thinking from one thing after another to one thing because of another. You know, the typical view of a cycle isn't totally wrong. It's just incomplete. We all see the upswing, then the downswing, right? But the real magic, the deeper truth, is that the upswing is actively, physically creating the downswing. All that prosperity and optimism, it makes people feel invincible. So they borrow more, they make riskier bets, and that slowly makes the whole system fragile, setting it up for the inevitable fall. I love this anecdote about Henry Kissinger because it just nails the point. You can't understand what's happening right now in a cycle without understanding the whole chain of events that got us here. It's why asking, so when did this cycle start, is kind of a useless question. It's not a race with a starting gun. It's a continuous river where every drop is just a consequence of the drop that came before it. Okay, on to section 2, the anatomy of a cycle. Now we're going to look at a super simple but really powerful drawing that Howard Marks uses to show his clients exactly where things stand. All right, here it is. It looks simple, but it's packed with meaning. You've got two main parts. First, that straight line climbing from bottom left to top right. That's what's called the secular trend. It's the long-term average. Over decades, economies grow, companies innovate, and things generally go up. But here's the thing. We don't live our lives on that smooth, straight line. We live on the wavy one, the oscillation. That's the cycle itself, the real world of booms and busts that happen around that long-term trend. Now let's put some signposts on that wavy line just to make it a little more real. See these letters, from A all the way to H, each one marks a different phase of the journey. This helps us get way more specific than just saying things are good or bad. It gives us a map. So let's trace that journey. We start at A, the recovery lifting off from a low point. By B, we've crossed the average line and optimism is really kicking in as we shoot for a high, which we hit at C. Then, of course, comes the correction at D. But, and this is so important, we almost never stop at the average. We swing right past it at E, heading down toward a new low at F. And from that despair, the whole thing starts over again at G and H. It's a dance. And the key thing to remember is that this is basically a perpetual motion machine. There's no official start bell or finish line. You can hop on at any point on this curve, and that point is always, always the result of what just happened and the cause of what's about to happen next. It just keeps going. So, what's the force that keeps this thing moving? What actually pushes it from those highs to the lows and back again? It's not some complicated economic formula. As we're about to see, the engine driving this whole thing is something we're all very familiar with: good old human nature. Marx uses this absolutely brilliant analogy, a pendulum. Just picture it. A pendulum swings from one extreme through the middle to the other extreme, right? Now imagine you could grab the point it's hanging from and just drag it from left to right over time. What shape would the swinging weight at the bottom trace out? It would draw a perfect cycle, just like the one we saw. They are literally two ways of seeing the exact same thing. But here's the twist. In markets, the force pulling the pendulum isn't gravity, it's us. It's our collective psychology swinging wildly back and forth. The pendulum swings between euphoria, where we're all convinced we're geniuses and things can only go up, and depression, where everyone's sure the world is ending. It's the swing from greed to fear, from blind optimism to bleak pessimism, from reckless risk-taking to total risk aversion. That's the engine. Okay, so if we swing way out to an extreme, what pulls us back? It's this incredibly powerful force called regression toward the mean. That midpoint, that straight secular trend line we saw earlier, think of it like a giant magnet. When things get way too hot or way too cold, there's this powerful, almost inevitable tendency for them to get pulled back toward the long-term average. And you have to get this part, the pendulum almost never, ever just swings back to the middle and stops peacefully. As it comes screaming back from an extreme, it has so much momentum, so much fear, or so much greed that it blows right past the center and goes all the way to the other side. That overshoot isn't a bug, it's a core feature of pretty much every cycle. Which brings us to our fourth section. So if every cycle is caused by something different, a tech boom, a housing crisis, whatever's next, how can we possibly learn from the past? Well, the answer is that while the costumes and the actors are always different, the plot of the play is remarkably consistent. This quote just nails it. The next crisis is not going to be an exact copy of the 2008 subprime mortgage meltdown, and anyone who's waiting for that exact scenario to repeat itself is going to miss the whole thing. But the themes that caused it, the excessive optimism, the complete disappearance of risk aversion, the belief that this time it's different, you can bet those will be back. Recognizing the rhyme is the skill. Here's that causal engine again, put another way. Think about it. During a big boom, all that success makes people feel bulletproof. It makes them complacent. It makes them take on dumb risks. Those very behaviors are the seeds of the eventual failure. And on the flip side, in the depths of a bust, all that failure and pessimism is what creates incredible bargains and forces people to be disciplined, planting the seeds for the next big recovery. Each extreme creates its own opposite. So the mechanics of how this thing flips are almost like physics. As the cycle swings up toward an extreme high, it's storing up potential energy in the form of greed and foolishness. Eventually, the gravity of reality, logic, fundamentals, starts to pull it back down. But the momentum of fear and panic selling is so powerful that it causes the cycle to overshoot that middle point and swing all the way to the opposite extreme of despair. So why is this so hard for us to see when we're in the middle of it? Marcus uses that old parable of the blind man and the elephant. You know the one. Each guy touches a different part, the leg, the trunk, the tail, and each one is absolutely convinced he knows what an elephant is. Well, we are those blind men. When we're in the middle of a powerful bull market, it feels like a tree trunk, solid, permanent, unmoving. We mistake that one part of the cycle for the whole animal and convince ourselves it's going to go on forever. All right, let's bring it all home in our last section with some timeless truths. These are the big bedrock ideas you can use to help navigate any cycle, no matter what crazy stuff is happening in the world. This quote from John Kenneth Galbraith is just brutal, and it is so true. The number one reason cycles keep catching people by surprise is what he called the extreme brevity of the financial memory. A new generation comes along, totally convinced that the old rules don't apply to them, that this time it's different, and then they proceed to get wiped out learning the exact same lessons their parents did. So let's end on 3 simple rules to keep in your back pocket. First, cycles are absolutely inevitable. Nothing goes up in a straight line forever. As the old saying goes, trees don't grow to the sky. Second, they are self-correcting. A boom contains the very ingredients of its own destruction. And third, and I love this one, they are symmetrical in direction. Up is followed by down, but they're not symmetrical in speed. The air goes out of the balloon much, much faster than it went in. Busts are often sudden and violent, while booms can take years to build. And that really leaves us with the final question, doesn't it? We have no idea what the specifics of the next cycle will be. Nobody does. But the underlying themes, the pendulum swing of human psychology from greed to fear, the siren song of this time it's different, the eventual powerful pullback to the average, those are timeless. They will be back. So the real challenge isn't about predicting the future. It's about understanding where we are in the present by recognizing these age-old patterns. So the question is, when they show up next time, will you recognize them?
You know, it's the question everyone wants an answer to, right? What is the market going to do next? We're all looking for those patterns, those secret formulas that are going to tell us exactly when to buy and when to sell. It's like this universal search for a crystal ball. But here's the thing. What if that whole quest, the very idea of it, is just wrong? Let's get into it. Because I promise you, grasping this one concept could totally flip how you think about investing forever.
So it really all comes down to this one single question. I mean, if they are predictable, then there's a formula for getting rich out there somewhere. But if they're not, then what are we supposed to do? Well, the answer, as it turns out, is kind of tricky. It's a little bit of both, and it all starts with what we even mean by the word cycle.
Okay, so check this out. When we think of a cycle, what pops into your head? For most of us, it's that thing on the left, the scientific ideal, right? A perfect, smooth sine wave. It repeats flawlessly, same height, same length, every single time. It's clean, it's predictable, but then you look at the right. And that, my friends, is the market. It's jagged, it's messy, it's driven by emotion. Yeah, it goes up and it goes down, but it never, ever does it the same way twice.
And this whole clash of definitions, this very idea, was at the heart of this incredible debate between the legendary investor Howard Marks and another top money manager, Nick Train. And the whole thing kicked off with an email and, believe it or not, ended over a pretty intense lunch in London.
The entire argument really boiled down to this. Nick Train's position was simple and clear. If you're going to call something a cycle, it has to be regular. It has to be predictable in its timing and in its size. You know, it has to look like that perfect wave we just saw. If it doesn't do that, then nope, you can't call it a cycle.
And you know what? He had a great point. If you're talking science, he was 100% correct. The physics definition describes something that follows a perfectly dependable, repeatable pattern. It always comes back to where it started. It's a closed loop, something you could literally set your watch to.
But Howard Marks was coming at this from a totally different angle. He was using a more general, I guess you could say, a more real-world definition. And look at the key phrase here, often repeated. See that? It's not always repeated. It's not identically repeated. And that little word, often, makes all the difference. It leaves room for the messiness, the irregularity that we see in the markets, and frankly, in life.
And this quote just nails the heart of Marx's whole philosophy. He's saying the real value isn't in knowing the exact day a cycle is going to turn. Not at all. The value is in understanding that things do rise and fall, and that our own human psychology tricks us into believing that whatever's happening now will happen forever. So the real money, the real edge, comes from betting against that flawed emotional thinking.
So, if market cycles aren't these perfect scientific patterns, what is it that makes them so darn irregular? Well, the answer is the single most important and, the most unpredictable ingredient in the entire recipe. It's us. We are the ghost in the machine. It's the involvement of people, with all of our hopes and our fears, our greed and our panic. That's what stops economic and market cycles from ever being neat and tidy and perfectly regular.
I mean, just think about it for a second. When everything's going great, optimism is rising, people buy more, and that pushes prices even higher. And when fear starts to creep in, pessimism takes over, people sell, and that pushes prices down. It's these big emotional swings, mixed in with just pure random chance, dumb luck, that creates the wild, unpredictable ride of the market. And here's the crazy part, the paradox. It's this very lack of dependability that creates the opportunity to win big. If it were easy and predictable, there'd be no money to be made.
Okay, so if the world is so random, why are we so desperate to believe in these clean, predictable patterns? Well, that gets us to a fundamental glitch in our own operating system, what you might call our brain's fatal flaw.
Physicist Leonard Mlodinow puts it perfectly. Our minds are basically pattern recognition machines on overdrive. We are just hardwired to look for cause and effect for everything. We can't stand the idea that maybe things just happen sometimes, for no reason, or because of a million tiny, random little things. And that makes us super vulnerable to seeing patterns where there's really nothing there at all.
Howard Marks tells this great story. He calls it quite annoying, which I love, from his own career in high-yield bonds. For a while, there was this myth going around that most bonds that were going to default would do it right around their second anniversary.
So how did a crazy idea like this even get started? Well, it began with just a coincidence. A couple of bonds just happened to default at around the 2-year mark, a completely random cluster. But from that tiny, insignificant little data point, investors created a rule. And from that rule, they built what they thought was a foolproof strategy. Just sell every bond you own before it hits its second birthday. I mean, it sounds so simple, right? So easy. But, like Mark says, this is such a classic case of mixing up coincidence with cause and effect. There was no real reason for it. It was just our human brain doing what it does best, right? That thirst for simple, helpful rules, as he calls it, just took over. And suddenly, we've built this massive theory on a foundation of nothing, just pure random chance.
To really get your head around the overwhelming power of randomness, let's just switch gears for a moment. Think about a pro baseball player. These guys have unbelievable skill. So why don't they hit a home run every single time they step up to the plate?
Because the outcome is swamped by a practically infinite number of random factors. How they feel that day, the way the wind is blowing, the glare from the stadium lights, the quality of that specific pitch, the pressure of the game situation, their exact hand-eye coordination in that split second, what they had for breakfast, if they slept well last night. I mean, the list goes on and on. The sheer volume of unpredictable stuff makes a perfect result impossible to guarantee, and it's the exact same for a company's stock price.
So, if trying to predict the future is a fool's game, and the world is just this chaotic, random place, are we just helpless? Are we supposed to give up? No, not at all. This is where we find the real edge as an investor. Because if you can't predict, you have to learn how to prepare.
What I love about Howard Marks is how honest he is about what he doesn't know. He just comes right out and says it. I will never know when a cycle will turn. I won't know how far it'll go, or how fast it'll move, or when it'll finally come back to normal. Think about that. These are the exact things that almost everybody else spends all their time and energy trying to figure out.
But then, right after admitting all that, he says this. And this is the whole secret. That tiny little bit that he does know, it's enough to give him a massive, massive advantage. And here it is. This is the whole game right here. Most investors, on the left, are on this hopeless quest for a magic formula, for that crystal ball that gives them perfect timing. The real edge, the investor's edge, comes from something way simpler, but so much more powerful. It's about understanding the general tendency for things to go up and for things to go down, figuring out roughly where we are in that process, and then setting up your portfolio to handle what's likely to come. See, it's not about predicting the rain, it's about building an arc. So I want to leave you with this question to think about. The next time you see it, the next time you hear about a can't-miss pattern, a foolproof investing rule, or a stock that can only go up, what are you going to see? Are you going to see a clear, guaranteed path to profit? Or will you see it for what it really is, just a good story, a compelling narrative born from our very human need to find order in a beautiful and beautifully random world?
You see the headlines every single day, right? The economy is booming. No, wait, a recession is just around the corner. Stocks are soaring, then they're tanking. It feels like complete and utter chaos, just a random, unpredictable storm of numbers. But what if I told you that underneath all that noise, there's a rhythm, a pattern, a set of interlocking cycles that once you really see them, change how you view everything? Well, that's exactly what we're going to break down today.
So here's how we're going to do it. First, we'll start with the economy's most basic building block. Then, we'll zoom way, way out to see the slow, powerful trend that lifts us up over decades. After that, we'll dive into the emotional roller coaster of booms and busts and discover that there's an even deeper, more powerful cycle hiding underneath it all. We'll ask the big question, why is it so hard to predict the future? And we'll wrap up by talking about how to navigate a world where, really, the only thing you can count on is uncertainty.
All right, so to find these hidden patterns, we first have to figure out what it is we're even measuring.
I mean, how do you possibly take the entire economic output of a country, all the cars, the coffees, the software, everything, and boil it down to a single number? It sounds impossibly complex, but the core idea, it's actually incredibly simple.
It's a little thing called gross domestic product, or GDP. And honestly, it all comes down to a simple bit of math. You take all the hours everyone in a country worked, and you multiply that by how much stuff, how much value they created in each one of those hours. That is it. That's the engine. Hours worked times productivity. And that simple little formula is the foundation for absolutely everything we're about to talk about.
Okay, let's peel back that first layer. If we take that GDP number and we plot it out over a really, really long time, we're talking decades, even centuries, something remarkable starts to appear once you ignore all the day-to-day drama.
When you smooth out all the bumps, all the recessions and booms, over generations, you get this, a surprisingly straight, upward climbing line. Economists have a name for this, the secular trend. You should think of it as the deep, powerful current flowing beneath all the choppy waves on the surface. It's the slow, almost silent story of human progress, just marching forward.
But you know, this line, it isn't magic. It doesn't just happen on its own. It's being pushed forward by two massive, slow-moving, and incredibly powerful engines that have been chugging along for centuries.
So the first engine is simply population growth. It's pretty straightforward, right? More people means more brains to invent things, more hands to build things, and more customers to buy those things. It's a force that shifts over generations. The second engine, though, is productivity growth. And this is the real game changer. This is all about getting more bang for your buck from every hour of work, thanks to huge leaps forward. Think the printing press, the internet, AI. It's the story of humanity working smarter, not just harder.
Now, here's what's so fascinating about that smooth, upward line we just saw. Nobody actually feels the economy that way. Our lived experience isn't some nice, steady climb. Nope, it's a total roller coaster.
In the real world, the economy looks a whole lot more like this. It swings way up into these periods of excitement and good times, and then it swings back down into periods of fear and recession. These are the famous business cycles, and they're like these waves of boom and bust that just dance all around that long-term trend line. This is the noise, the drama, this is the stuff we actually feel in our jobs and in our wallets. And this part is absolutely crucial. These cycles aren't caused by some law of physics. They're not predictable like the seasons. They are driven by one of the most powerful and, let's face it, fickle forces in the universe: human emotion. Our collective greed, our fear, our optimism. Just think about it for a second. Good news in the headlines makes us feel confident, so maybe we spend a little more. When our house or our stock portfolio goes up in value, we feel richer. That's the so-called wealth effect. And we start to loosen our purse strings. And here's the real kicker. When enough of us believe the future is going to be good, we borrow and we invest and we spend, which in turn actually creates that good future. It's this massive psychological feedback loop. Okay. So we've got the deep, slow current of long-term growth, and we've got the choppy, emotional waves of the business cycle on top. But what if that deep current, that straight line we drew earlier, isn't actually straight at all? What if the entire river can change its course? And this right here is maybe the most profound idea of them all. That long-term trend can itself bend. It can speed up for decades and then slow down for decades. What feels like a permanent new era of amazing prosperity might just be the upward swing of a much, much larger and slower cycle. It is literally a cycle buried deep inside another cycle, moving at a glacial pace.
So what kind of force is powerful enough to bend the entire arc of economic history? Well, we are talking about absolute tectonic shifts, things like the rise of globalization that completely rewired the entire planet's manufacturing base, or a technological revolution like artificial intelligence that could redefine what work even means, or massive demographic shifts. These aren't the kinds of things that just cause a recession. These are the things that define an entire century.
So, now that we have all these layers, the trend, the cycle, and the bending of the trend, surely we can put it all together and predict what's coming next, right? Well, not so fast.
You know, it reminds me of what the great economist John Kenneth Galbraith once said. He quipped that economic forecasting is pretty much a fool's errand. The system is just too complex, it's too human, and it's way too subject to random shocks to be mapped out with any kind of real accuracy. And this is the trap every forecaster falls into. See, the easy prediction is just to say that tomorrow is going to look a lot like today. And you know what? You'll probably be right. But that's not helpful to anybody. The really valuable prediction, the one that calls the next big crisis or the next big boom, that's a massive long shot. It is almost guaranteed to be wrong. So, you see the dilemma? The safe forecast is useless, and the useful forecast is almost always wrong.
So, if we can't predict the future, what's the point of all this? Well, the goal isn't prediction. The goal is recognition. It's about learning to ask the right question. Where are we now in these overlapping cycles?
Just look at the Brexit vote back in 2016. The professional forecasters, the betting markets, the pundits, pretty much nobody saw it coming. It was a huge surprise. In an instant, it sent a shockwave through that short-term cycle of human emotion. But more importantly, it was an event big enough that it may have actually bent the long-term trend for both the UK and all of Europe for generations to come.
And these kinds of shocks from outside the system, economists have a fancy word for them, exogenous events. They're a constant reminder that no model, no matter how smart, can account for everything. A political earthquake, a new invention, a global pandemic. They can just appear out of the blue and completely change the rules of the game.
And that brings us to our final question. See, the goal of understanding all these cycles isn't to get a perfect map of the future. It's to get a better compass for the present. It's about appreciating the deep fundamentals, respecting the incredible power of human psychology, and just staying humble in the face of a deeply unpredictable world. So look around. If an event like Brexit could bend the path back in 2016, what forces are at play right now, today, that might be quietly redefining our economic future for the next 50 years?
You know, the economy, it kind of feels like this powerful, unpredictable ocean, right? You've got these massive waves of growth, these booms, followed by these crashing recessions, these busts. But here's the thing. It's not just left to the whims of the current. There are institutions constantly at work with a hand on the tiller, trying to steer us through these really turbulent waters. And today, in this explainer, we're going to break down exactly how they do it. All right, so let's just dive right into the fundamental question. Why all the drama? Seriously, why can't we just have nice, steady, predictable growth? Why is the economic story always one of these massive booms and these painful busts? It's a puzzle, and it's one that has challenged economists and policymakers for, well, centuries. So to get to the bottom of this, here's our game plan for today. First, we're going to look at the economic cycle itself and why it's even a problem. Then we'll meet the two main players who have their hands on the controls, the central bank and the government. After that, we'll break down the incredibly delicate balancing act they have to perform. And finally, we're going to ask, is this a puzzle that can ever really be solved? Okay, first stop on our tour, the unruly economic cycle. Now, it might seem a little odd to complain when the economy is booming, right? I mean, what's not to like? But as we're about to see, too much of a good thing is a very real problem, and it can set the stage for a pretty inevitable crash. And this right here is where you see the real-world impact. It lays out the human cost at both extremes. When there's too much strength, when an economy is just overheating, it kindles inflation. And that's not just some abstract number. That means your paycheck doesn't go as far at the grocery store. It can also create these dangerous asset bubbles that are just bound to pop. And on the flip side, too much weakness? Well, that means businesses see their profits evaporate, investment dries up, and most importantly, people lose their jobs. The stakes for everyday life are just incredibly high on both sides of this equation. So you can see why the folks in charge don't just, sit on their hands and watch this happen. They engage in what's called counter-cyclical policy. The core idea is actually pretty simple, but it's really powerful. You act as a counterweight. When the economy gets too hot, you apply the brakes to cool it down. When it gets too cold and sluggish, you hit the accelerator to warm it up. It's all about leaning against the prevailing economic wind. All right, let's bring our first major player onto the stage. Meet the central bank. In the modern era, you can think of it as something like the economy's primary physician, constantly checking its vital signs and prescribing medicine to keep it healthy. Now, you might think of a central bank as just, the place that prints money. And yeah, that used to be a huge part of it, but that role has evolved dramatically. Today, their main concern, their primary job, is managing the economic cycle itself. And for decades, the number one target of that management has been one thing in particular: inflation. And this is where it gets really tricky. This is the core conflict, the tightrope walk at the heart of modern central banking. They have what's often called a dual mandate. Job number one, fight inflation. To do that, you have to restrain the economy, slow things down. But job number 2 is to support employment, which requires the exact opposite. You have to stimulate the economy to help it grow. So they're basically being told to hit the brakes and the accelerator at the same time. This internal conflict gives rise to 2 archetypes, 2 camps that you'll hear about all the time: hawks and doves. Hawks are the central bankers who are just laser-focused on keeping inflation under control, even if it means slowing down the economy. They are quick to apply the brakes. Doves, on the other hand, prioritize getting people jobs. They lean towards stimulus and are more willing to risk a little bit of inflation to get more people working. Okay, so let's say the economy is running hot and the hawks are getting nervous. What's in their toolkit? What do they actually do? Well, first, they raise interest rates. That makes it more expensive for you to get a mortgage or for a business to take out a loan, which naturally cools down spending. They can also reduce the money supply and sell government securities to banks, which basically pulls money out of the financial system. It's all designed to take some steam out of the economy. But what happens when things go the other way? When the economy is in a slump and the doves are in charge? Well, they do the exact reverse. They cut interest rates to make it cheaper to borrow and spend. They increase the money supply, and they buy securities from the private sector. That last one, which you might have heard of as quantitative easing, is basically the central bank creating new digital money to buy up these assets, injecting cash directly into the system to get things flowing again. But hold on, the central bank isn't the only one with a hand on the tiller. There's another huge player in this game, the government itself. And it has a whole different set of levers, all focused on 2 things it controls directly: taxing and spending. And their set of tools? That's what we call fiscal policy. It's totally different from the central bank's monetary policy. Fiscal policy is all about the government's decisions on how to collect money through taxes and then how to spend that money. And believe me, those decisions can have a massive direct impact on the whole economy. Now, a lot of the thinking behind this goes back to one guy, the economist John Maynard Keynes. His big idea, which was a total game changer at the time, was that governments shouldn't just be passive accountants trying to balance the books every year. No, they should actively use their power of spending and taxing to manage the total demand in the economy and smooth out those violent swings of the cycle. And this table here lays out the Keynesian idea perfectly. It's actually pretty straightforward. When the economy is weak, the government should run a deficit. That means it spends more money than it takes in through taxes, pumping cash into the economy to stimulate demand. Think stimulus checks or big infrastructure projects. Now, conversely, when the economy is strong, maybe even overheating, the government is supposed to do the opposite, run a surplus by taxing more than it spends, which pulls money out of the economy to cool things down. Okay, so on paper, this all makes a ton of sense, right? Cool things down when they're hot, heat them up when they're cold. But, and this is a big but, this is where sound economic theory smacks right into the wall of political reality. I mean, just imagine being in that room, looking at all the messy, conflicting data. This is the question that keeps central bankers and treasury officials up at night. Is it time to hit the gas or the brakes? And if you do hit one, how hard do you push? Acting too late or acting too aggressively can easily make the whole problem way worse. And on the government side, it's even worse. This quote from the investor Howard Marks just nails it. It's one thing to say, in theory, that you should raise taxes or cut spending during a boom to cool things down, but in the real world, what politician wants to be the one to take away the punch bowl just when the party is getting good? And that gets to the absolute core of the problem. There's a fundamental political imbalance. It is always more popular to cut taxes and increase spending to fight a recession that everyone can see and feel. That's being a hero. But raising taxes or cutting spending to prevent a future, invisible problem of overheating, well, that's asking voters to take some nasty-tasting medicine when they feel perfectly healthy. It's a tough sell, which is why, as Marx notes, government surpluses have become as rare as buggy whips. So where does all this leave us? With all these conflicting goals and political headaches, is trying to manage the economic cycle just an unsolvable puzzle? Well, it's for sure more of an art than it is a precise science. Let's just pull all the threads together for a second. Why is this so insanely hard? Well, first, the central bank's 2 main jobs are literally fighting each other. Second, the correct fiscal policy, running a surplus in good times, is almost politically impossible to do. Third, nobody, and I mean nobody, knows for sure the right timing or the right amount of intervention. And finally, you have this giant, unpredictable wild card, human psychology. Confidence and fear. And honestly, this quote brings it all home. The fact that we even have these massive booms and busts, That's all the proof you need that this is anything but easy. If managing the cycle were simple, if there were some perfect formula to follow, we just wouldn't see the kind of volatility we do. So I'll leave you with this question to chew on. If the people with their hands on the teller are navigating with imperfect tools and conflicting maps, guided as much by gut feelings as by data, what does that mean for our economic future? What does the next boom or the next bust look like in a world where managing the cycle remains far more of an art than a science? All right, let's dive into a really fascinating puzzle drawing from Howard Marks's Mastering the Market Cycle. Here it is. Why is it that corporate profits seem to be on this wild up and down roller coaster when the economy as a whole is, just kind of taking a leisurely stroll? It's a question that, once you get it, really unlocks how markets behave. So let's start right there with this central mystery. You look at the economy, you see these gradual, flowing waves of growth and recession, but then you look at corporate earnings reports, and it's just whiplash, massive booms, devastating busts. They're obviously connected, but they're moving at totally different speeds and intensities. So what on earth is causing that huge gap in volatility? And this visual, wow, it just lays it all out, doesn't it? On the left, you've got GDP growth. It's a pretty smooth wave, almost always tucked inside that calm little channel between +5 and -2%. But then you look to the right. Corporate profits look more like a crazy EKG reading. The line is sharp, jagged, with these incredible peaks and terrifying valleys. The swings are just so much bigger. So what this really boils down to is that while the profit cycle is absolutely tied to the economic cycle, it's like an amplified, supercharged, extreme version of it. And that's what we're going to do here. We're going to take apart the engine and see exactly what's causing all that extra horsepower. So where do we even begin to untangle this? Well, the first piece of the puzzle is surprisingly simple. It starts with what companies are actually selling. It turns out how sensitive a company's sales are to the economy is the very first step in this whole story. Yeah, some industries just feel the bumps in the road way more than others. Think about it. When times get a little tough, what's the first thing you or a business puts off? It's the big ticket items, right? A new car, a new house, that big factory upgrade. You can delay those things. And the same goes for raw materials for industry or luxury goods. Their sales are just incredibly sensitive to how healthy the economy feels. On the flip side, you've got these industries that have a much smoother ride. I mean, people need to buy groceries, pick up prescriptions, and get their hair cut whether the economy is booming or busting. Demand for these everyday necessities is just way more stable. But here's the thing. This difference, as important as it is just the tip of the iceberg. It doesn't explain the whole story, not even close. So if the kind of stuff a company sells doesn't fully explain those wild profit swings, what does? Well, the answer is an incredibly powerful force that acts like a financial amplifier on everything. It's a concept called leverage. The best way to think about leverage is like a magnifying glass for a company's results. It takes a small, modest change in sales and blows it up into a much bigger change in profits. It makes the good times feel incredible and the bad times feel absolutely brutal. And there are two main types we need to get our heads around. Okay, this first type, operating leverage, is literally built into the DNA of a company's day-to-day business. It all comes from the mix of costs a company has. Some costs that move up and down with sales, and some that are just stuck there no matter what. Let's use a super simple example, a taxi cab company. Think about its costs. First, you've got fixed costs, like the rent for their office. They have to pay that every month, whether they give one ride or 1,000 rides. Then you have semi-fixed costs, like the cars themselves. One extra ride doesn't mean a new car, but a huge surge in business might. And finally, you have the purely variable costs, like gasoline. Every single mile you drive burns more gas. Simple, right? And this is where the magic happens. Because some of those costs are fixed, when sales go up by, let's say, 20%, the company's total costs go up by less than 20%. And that gap means that profits shoot up by way more than 20%. But, and this is a huge but, that magnifying glass works both ways. A 20% drop in sales can cause a much bigger, much more painful plunge in profits. All right, on to the second magnifier, financial leverage. This one isn't about day-to-day operations. It's all about how a company pays for everything, specifically how much money it has borrowed. So picture this. A company is funded with two big pools of money. Half of it comes from the owners, that's called equity. The other half is a big loan from the bank, and that's called debt. Now, that debt comes with some serious strings attached. Fixed, non-negotiable interest payments. The bank has to get paid, period, no matter how the business is doing. And the math here is just stark. Look at what happens. The company's operating profit drops by a third, from $3,000 to $2,000. Now, that's bad, but maybe manageable. But because that $1,500 interest payment doesn't change, it has to be paid in full. And boom, the pain gets magnified, and the net income for the actual owners collapses by a shocking 67%. That's financial leverage in action. Okay, so we've got the economy's rhythm, and we've got these two powerful forms of leverage amplifying everything. But what happens when something comes completely out of left field and just breaks the whole system? We're talking about factors that operate outside the normal cycle. And the ultimate wildcard, the great disruptor, is technology. This is a force so powerful it can make the entire economic cycle almost irrelevant for a company, or even an entire industry. It can just completely change the rules of the game overnight. And one very famous industry found this out in the hardest way possible. The newspaper industry is the perfect cautionary tale. You know, back in the 90s, they were considered rock-solid investments. They had what people called an impregnable moat, a totally defensive, stable business. And then the internet showed up. Suddenly, information was free, and local classified ads had a new, cheaper competitor. Today, that moat is gone, totally evaporated, and the entire industry is fighting for survival, all because of a game-changing factor that had nothing to do with a normal recession. This quote from the book just captures the new reality we're in perfectly. The pace of change has gone into overdrive. What seemed like a secure, dominant business model just a few years ago can be made obsolete faster than we've ever seen before. It means no industry's position is ever truly safe anymore. So let's pull all these threads together. What does this all mean for us? Trying to make sense of this new, wilder world. What's the big takeaway? To recap, you really have these four forces that combine to create that profit roller coaster. You start with how sensitive a company's sales are to the economy. Then you amplify that with operating leverage from its fixed costs. Then you amplify it again with financial leverage from its debt. And then layered over all of that, you have the constant threat of some game-changing, idiosyncratic disruption like technology. And this right here is probably the most important idea to grasp. Decades ago, the world felt like a stable stage where these economic cycles would play out in a somewhat predictable way. But today, because of technology and huge social shifts, the stage itself is constantly morphing and changing under our feet. The old rules don't always apply. And that leaves us with this one big, lingering question to think about. As we try to understand the world, as investors, as business people, as just curious observers, we now have to analyze two things. Not just the ups and downs of the cycle, but also the stability of the very ground the cycle is happening on. Because in a world of constant disruption, just mastering the cycle might not be enough anymore. You know, in the world of investing, there's this one force that's way more powerful than any spreadsheet or algorithm, and that's human emotion. Today, we're going to dig into the work of the legendary investor Howard Marks to really understand the psychological pendulum that pulls markets from one crazy extreme to the other. So have you ever actually stopped and wondered about this? 1 minute, everything looks absolutely perfect, and the next, it's like the world is ending. I mean, it's a really fundamental question about how investing works, right? In the real world, things usually move between pretty good and not so hot. But in the markets, it's like we completely skip the middle and just swing from flawless to hopeless. Why does that happen? Well, the answer, it lies in this really powerful metaphor. And here it is, the pendulum of investor psychology. I want you to picture a real pendulum, like in a grandfather clock. You know, its average spot is right there in the middle, but it spends almost zero time actually at the middle. It's always in motion, always arcing towards one extreme or the other. And Howard Marks's big idea is that the collective mood of the market works in exactly the same way. All right, section 1, the psychology pendulum. Let's really dig into this core concept. What's actually driving this constant motion, and what on earth does it mean for anyone trying to navigate these markets? And you know, this is not some new flash-in-the-pan idea. Marks was writing about this way back in 1991. What's so insightful here is that the movement towards one extreme is what actually provides the energy for the swing back. It's like The higher that thing swings on the side of greed, the more potential energy it's storing up for that crazy, and often just as extreme, swing back towards fear. All right, section 2, anatomy of the swing. So, we get it, the pendulum swings. But what exactly is it swinging between? To really get a handle on this, we've got to dissect the emotional pairs that give it all its power. Okay, so it all kicks off right here with this fundamental swing between euphoria and depression. You can think of these as kind of the base layer of emotion. When investors are euphoric, they're only seeing the good stuff, only celebrating the positives. And that creates the perfect breeding ground for greed to take over. But on the flip side, when they're depressed, they just obsess over every little negative thing. And that is the fertile soil where fear starts to sprout. And that, of course, leads us to the most famous pair of them all, greed and fear. When greed is running the show, the only thing anyone can think about is making money. Everyone wants to buy, which creates this fierce competition that just shoves prices higher and higher. But when that pendulum swings back, fear takes the wheel. The focus shifts completely to not losing money. Suddenly, the buying just dries up, the sellers come out in force, and, well, you know what happens to prices. And right on the heels of that, you've got the swing between optimism and pessimism. This is really all about what we think is going to happen next. Optimism is what makes us believe the good times are just going to keep on rolling, and that encourages us to take on more and more risk. Pessimism does the exact opposite. It convinces us that something bad is just around the corner, which leads to extreme caution. And this shows you exactly what happens as a result. An investor's willingness to take on risk isn't some fixed personality trait. Oh no. When prices are shooting up and everyone feels like a genius, their risk tolerance is through the roof. But after a big drop, when those losses are fresh and painful, risk aversion completely takes over. The main goal becomes just one thing: don't lose any more money. So here's the bottom line. All these emotional states, they're all tangled up together. They feed on each other, creating this powerful psychological force that boils down to just two behaviors: this frantic urgency to buy when the pendulum is high, and a desperate panic to sell when it swings low. Now, I know this all might sound a little abstract, but believe me, there is some wild data that backs this whole thing up. You know, we all like to think there's some kind of normal for the market, right? A place it usually hangs out. But how often is the market actually normal? The answer, well, it's going to surprise you. Just look at this number. That's right, 3. Just 3 times. In nearly half a century, the S&P 500's annual return only landed in that quote-unquote normal range of 8 to 12%, 3 times. I mean, think about that. Over a quarter of the time, it was more than 20 percentage points away from that normal range. This is the hard proof right here. The market spends almost all of its time at the extremes. The average is most definitely not the norm. Okay, section 3, from greed to fear. So the data proves this pendulum is the real deal. Now let's see what it looks like out in the wild. And honestly, there is no better case study for this than the rise and fall of the dot-com bubble. Okay, so cast your mind back to 1999. Greed was absolutely in the driver's seat. The battle cry was, "It's a new paradigm." If you were being careful, you were made to feel like an idiot watching everyone else get rich. Then, in 2000, that pendulum started its violent swing back. Greed just vanished, and fear moved in. By 2002, fear was totally dominant. The mantra wasn't buy before you miss out anymore, it was sell before it goes to zero. But here's the key. It was right there, at that point of extreme pessimism in 2003, that the best opportunities popped up for the very few people who could actually resist that swing. This quote just perfectly nails the psychology at a market peak. It's a completely one-sided world. That normal tug of war between optimists and pessimists, it's over. It's like everyone just drops their end of the rope and runs over to the same side, the side of greed. And when there's no opposing force, there's nothing to stop prices from just going vertical. Okay, section 4, the perception filter. Now this is where things get really interesting, because the pendulum's power, it's more profound than you might think. It doesn't just react to what's happening, it literally changes how we see what's happening in the first place. It puts this powerful filter over our view of reality. So Marx breaks this filter down into 2 main problems. First, there's selective perception. That's where we only pay attention to the news that confirms the mood we're already in. And second, there's skewed interpretation. This is where we take any piece of news, good, bad, whatever, and we twist it until it fits the optimistic or pessimistic story we're already telling ourselves. And wow, this classic cartoon just says it all, doesn't it? The actual facts of the world didn't change overnight. What changed was the emotional lens the market was using to look at those facts. The interpretation just does a complete 180. Just check out this list from the investor John Brooks. It is a perfect example of just how warped our thinking can get. When the market's in a good mood, literally everything is a reason to buy. Strong economic data is good news, but weak economic data, that's also good news because it means the Fed will step in. Oil goes up, great. Oil goes down, also great. It's not about the data, it's about the relentless, can't-be-stopped positive spin.
And this one captures the sheer absurdity of it all. A single piece of news, lower interest rates, can be seen as bullish, then bearish, then bullish again. How? Well, lower rates can help the economy, that's good, but they might cause inflation, that's bad, which could mean higher rates later, that's really bad. The market's interpretation can just bounce around like a pinball depending on which part of that story it wants to focus on at any given second. All right, our final section, resisting the swing. We've seen how this thing works, how it messes with our heads. So that brings us to the biggest question of all, right? What do we do about it? How can we as investors actually learn to resist being pulled along for the ride?
Marx draws a really sharp contrast here. The typical investor is totally reactive. Their emotions are just a product of what the market is doing. They get greedy after prices have already gone up, and they get scared after prices have already fallen. The superior investor does the exact opposite. They don't just fight these urges, they actively use them as signals. They understand that the time to be cautious is when everyone else is greedy, and the time to get greedy is when everyone else is terrified. They strike a balance, refusing to let either emotion take complete control. But look, let's be real for a second. This is so much easier said than done. Most of us just aren't wired this way. We swing to those emotional extremes at precisely the worst possible time. Resisting that pull from the herd takes a ton of self-awareness and discipline. It's like Marx says, being naturally unemotional is a huge gift when it comes to investing. Maybe not so much for the rest of your life, but hey, for the rest of us, it's a skill we have to work on constantly. And really, that's the ultimate lesson here. Just understanding that this pendulum exists is the first huge step. Recognizing that the market is always in motion, always swinging between euphoria and despair, that's the key insight. The pendulum is never ever going to stop. So the only question left, the only one that really matters, is for you. Now that you can see how it all works, are you going to let it pull you along for the ride? You know, there's this force in investing that's way more powerful than any algorithm or earnings report, but most of us barely even think about it. It's the wild, dramatic cycle in our attitude toward risk. If you can get a handle on this, it's like having a key to the entire market. But if you get it wrong, well, it will absolutely control you. This is just perfect. It captures the whole emotional roller coaster of being an investor. In the good times, we're all like, risk is my friend. We feel like geniuses, totally invincible, just chasing bigger and bigger returns. But the moment the market turns south, that feeling just evaporates. It flips to, I just don't want to lose anymore, get me out. Fear completely takes over, and the only goal is to stop the bleeding. This isn't just a simple mood swing. This is the very engine that drives market cycles to their insane extremes. All right, so here's the game plan. First, we're going to build the ideal model of how investing is supposed to work, in a perfectly rational world. Then, we'll see what happens when greed completely takes over and just shatters that model. After that, we'll look at the inevitable crash when fear dominates everything. And finally, we'll pull it all together and see how understanding this cycle gives the smart investor a massive, massive edge. Okay, let's start with the textbook version. In a perfect world, how should we be thinking about risk? This part is super important because it lays the foundation for everything else. This is a sane, logical world that, honestly, only exists in theory. So, the bedrock of this whole rational world is a really simple idea: risk aversion. Let's be honest, most of us don't really enjoy uncertainty. We prefer a sure thing. So if you want me to take a gamble, if you want me to invest in your risky new venture, instead of just putting my money in a safe government bond, you've got to make it worth my while. You have to offer me the chance at a much higher reward. This one little assumption is what's supposed to keep the entire market orderly and sane. And this is what that looks like. It's one of the first things you learn in finance, and it's just beautifully simple and intuitive. As you move to the right on this chart, you're taking on more risk. And to get people to do that, the line has to slope up, showing that the potential return has to go up too.
Now, the key word here, and I can't stress this enough, is potential. Because if riskier assets guaranteed a higher return, they wouldn't actually be risky, no, would they? And that simple idea builds out to this, the full picture, the capital market line. Now, this line is basically formed by the collective demands of every single risk-averse investor out there. You can see how different types of investments, from the ultra-safe stuff like money markets way over on the left, to bonds, and then all the way to really speculative venture capital on the far right, they should all line up nicely. Each one offers just a little more potential return for taking on just a little more risk. In a rational world, everything is priced fairly. It all makes sense.
So here's the crucial takeaway. When investors are properly risk-averse, the market is actually a pretty safe and sane place. People do their homework, they're skeptical, they demand to be paid extra for taking risks, that's the risk premium, and they know how to walk away from deals that seem too good to be true. These behaviors are basically the immune system of the financial world. They protect it from speculative fevers. At least, in theory. All right, now we get to the really interesting part. What happens when things are going great? Prices are rising, and there's a constant stream of good news. What happens when investors, as a group, completely forget everything we just talked about? What happens when risk aversion just disappears? Well, it creates this incredibly dangerous feedback loop. It all starts with some good news, which makes everyone optimistic. That optimism makes people feel like risk is an old-fashioned idea. So they stop demanding that extra compensation, that risk premium to buy risky things. And when no one is demanding high returns anymore, what happens? Asset prices get bid up and up and up. And here's the crazy paradox. As the prices rise, the assets become objectively riskier. But those very same high prices attract even more buyers, which just feeds the bubble. Now, this is probably the most important visual we're going to look at. On the left, you've got that beautiful, rational capital market line we saw before. It makes sense. But on the right, look at what happens when greed takes over. The line just flattens out. The slope of that line represents your reward for taking risk. And here, it's almost gone. You're taking on a massive amount of risk, moving way out to the right, for practically no additional potential return. This is exactly what a market peak looks like. The payoff for being brave has completely vanished.
And this quote, wow, this is from the CEO of Citigroup just a few months before the 2008 financial crisis blew up. It perfectly captures the madness of that time. He's basically saying, yeah, we know this is a party that has to end, and we know it's going to be ugly, but the fear of missing out is so strong that everybody feels like they have to keep dancing. They have to keep participating in what Howard Marks calls the race to the bottom. Just let that sink in for a second. This is the ultimate paradox of the entire cycle. The moment of maximum danger, when prices are highest and the underlying businesses are weakest, is precisely the moment when most people feel the safest. They've literally forgotten what risk even feels like, and that is the single biggest risk of all. Of course, the music always stops. The bubble always pops. And when it does, that psychological pendulum doesn't just swing back to the middle. Oh no, it flies violently, uncontrollably to the other extreme, from boundless greed to just all-consuming fear. At the bottom of a market crash, the psychology is a perfect mirror image of the top. The very same people who a year ago believed nothing could ever go wrong are now absolutely convinced that nothing can ever go right again. They're scarred, they're panicked by their recent losses, they sell whatever they have left, often at the worst possible prices, swearing they'll never touch the market again. Their risk aversion, which was totally absent at the top, is now completely excessive and irrational at the bottom. And look what this does to our risk/return line. Fear makes the line incredibly steep. Remember, the slope of the line is the reward you get for bearing risk. Well, in a fearful market, the potential returns for taking on even a little bit of risk become enormous. The market is practically screaming, offering these incredible bargains, this generous compensation for anyone willing to be brave, but nobody wants to take the offer. The reward is highest precisely because no one is willing to bear any risk. To really make this concrete, let's look at a story Howard Marks tells from the absolute depths of the 2008 crisis. He's trying to convince a major pension fund to invest when assets are dirt cheap, but he keeps running into this one terrifying, paralyzing question. It's like the mantra of a panicked market. So Marks walks them through the data. He says, look, even if we assume default rates just hit our historical average, the returns on this investment are fantastic. And they say, yeah, but what if it's worse?
So he says, okay, let's assume our worst 5-year period ever. The returns are still great. And they just come back with, but what if it's worse? He finally shows them the single worst year in the history of the entire high-yield market, a 12.8% default rate. Even under that catastrophic scenario, the investment still works. But the fear is just so deep, they can't stop asking, but what if it's worse than that? They've completely lost the ability to think rationally about risk.
And that right there is the powerful lesson from that story. The pension fund's complete inability to imagine anything but disaster, their total, suffocating pessimism, was the ultimate sign that every last drop of optimism had been wrung out of prices. It was the flashing green light that risk was actually at its lowest and potential reward was at its absolute highest. The moment of maximum pessimism is the moment of maximum opportunity.
So we've seen the two extremes, right? The foolish optimism at the top and the irrational terror at the bottom. So how does a superior investor actually use this knowledge? Well, this is where the contrarian mindset really comes into play.
First off, you have to realize that this cycle isn't some rare once-in-a-decade event. Just look at this chart. The market doesn't just hang out around that straight line of fair value, that happy medium. It's almost always swinging away from it, careening toward one extreme or the other. This constant oscillation, driven purely by human psychology, is the normal state of affairs. And Warren Buffett, of course, sums up the contrarian response perfectly. Your job is not to follow the crowd. Your job is to be the counterbalance. When everyone else is throwing caution to the wind and acting recklessly, you must become more cautious, more prudent. And just as important, when everyone else is panicked and selling everything in sight, that's your signal to become more aggressive.
And this is such a crucial distinction to make. Being a contrarian doesn't mean you're always a pessimist, always betting against everything. That's just as wrong as being a permanent bull. True skepticism is about being a realist. So when the market is euphoric and everyone's celebrating, a skeptic leans toward pessimism. But when the market is drowning in despair and everyone thinks the world is ending, a true skeptic starts to lean toward optimism, recognizing that things have probably gone way too far.
And that leaves us with the single most powerful question you can ask about any investment at any time. Just ask yourself, how much optimism is already factored into this price? Is the price reflecting wild, blue sky optimism where there's absolutely no room for error? Or is it reflecting total abject pessimism where any news that isn't a complete catastrophe will probably cause the price to rise? The answer to that one question tells you almost everything you need to know about where we are in the great psychological cycle of risk. Welcome to The Explainer. Today, we are digging into a force that the legendary investor Howard Marks says is the single most powerful, most volatile cycle in all of finance. It's this hidden current that can literally build empires during a crisis, and then just as easily tear them all down when everything seems to be going perfectly. So what is this invisible hand that's shaping our financial world? So let me ask you this. What single force has the power to make you a fortune when everyone else is losing their shirt, but can absolutely wreck you when the good times are rolling? The answer is, well, it's totally counterintuitive, and it lies right at the heart of something called the credit cycle. So, in this explainer, we are going to unravel this thing together. First up, we'll cover what the credit cycle even is and why it's so important. Then we'll get into the nuts and bolts of how it actually works. We're going to use the global financial crisis as a real-world and pretty scary case study. And finally, we'll learn how you can start to spot the signals for yourself. All right, let's jump right in. You know, we spend a lot of time talking about the economy, right? It's gentle ups and downs, but there's this other cycle that swings wildly. I mean, from one crazy extreme to the other, and its impact is just so much more dramatic. That, my friends, is the credit cycle. Howard Marks just nails it here. A tiny little ripple in the economy can create an absolute tidal wave in the world of credit. And then that wave comes crashing down on asset prices, and all that energy just feeds right back into the economy, creating this incredibly powerful, self-perpetuating feedback loop. To really get this, let's use a simple metaphor that Marx talks about, the credit window. Just picture a giant window, and it's the gateway to all borrowed money. Sometimes that window is thrown wide open and cash is just pouring out. Other times, though, it slams shut, like without any warning, and the flow of money just stops dead in its tracks. This constant opening and shutting, that is the credit cycle. So, okay, why is this window such a big deal? Well, because credit is basically the oxygen of our modern economy. When it stops flowing, everything, and I mean everything, grinds to a screeching halt. Let's break down the 4 big ways this cycle really shapes our world.
First off, growth. Simple. Companies need to borrow money to build new factories, hire people, expand. No credit, no growth. It's that basic. Second, debt. Now, here's a secret. Most corporate debt never really gets paid off. It just gets replaced with new debt. They call it rolling over. Well, if that credit window slams shut, you can't get new debt, and that means defaults. Third, the financial system itself. Banks and lenders, their entire business is money. They need constant access to credit to survive. And finally, and this one's huge, is psychology. A closed credit market is like someone yelling fire in a crowded theater. It spreads panic and creates a self-fulfilling prophecy of fear. And this brings us to a classic trap. Companies will often use cheap short-term loans, think 30-day loans, to buy long-term assets, like a giant office building. Now that strategy works great, as long as you can keep getting a new 30-day loan every month. But what happens when the credit window slams shut? All of a sudden, you're left holding this building you can't sell and a massive bill you can't possibly pay. This mismatch is behind some of the biggest, most spectacular blow-ups in financial history. So how does this whole thing actually work? Well, the credit cycle isn't some random event. It's actually a pretty predictable, self-reinforcing loop. And the most important thing to get your head around is this. The seeds of the bust are always sown during the boom. It all starts with good times, right? The economy's humming along, profits are up, everyone's feeling optimistic. Lenders, who are just swimming in cash, they start to forget about risk. They're all competing with each other to lend money, which forces them to offer easier and easier terms. Lower interest rates, fewer rules. And this is the key moment. Money starts flowing to riskier and riskier projects. Stuff that would have been laughed out of the room just a few years earlier. And this leads us to the great paradox of the whole cycle. It's at the absolute peak of optimism, when everything feels the safest, that lenders are actually making their worst, most reckless decisions. The seeds of the coming crisis are being planted right there, at the height of the good times. And then, reality bites. Inevitably, those super risky loans start to go bad, and losses start piling up. Greed is instantly replaced by fear. Lenders who are just throwing money at people now slam that credit window shut. Interest rates spike, and lending standards become almost impossibly high. This chokes off credit for everyone, even the healthy, good companies, which leads to a huge wave of defaults and pushes the economy deeper and deeper into a downturn. This quote from Marx Realist just perfectly captures the whole feedback loop in one sentence. It's like a perpetual motion machine, where each phase just inevitably leads to the next, swinging from the extreme of greed all the way to the extreme of fear, and then eventually all the way back again. Now, let's take this all from theory to reality, with probably the most catastrophic example in any of our lifetimes, the 2008 global financial crisis. This wasn't just some recession. It was a complete and total meltdown of the financial system, born entirely within the credit cycle, that pushed the whole world right to the brink of collapse. The speed of the collapse was just breathtaking. In 2006, the first little cracks started to show up as some of these subprime mortgage defaults began to rise. By 2007, the financial products built on those mortgages had become toxic waste, and the markets for them just froze solid. And then came the breaking point, September 2008. The collapse of Lehman Brothers sent this shockwave of pure panic across the entire globe, slamming that credit window shut for everyone, everywhere, all at once. So what caused this perfect storm? Well, it was the credit cycle on steroids. First, you had a total, carefree disregard for risk. Investors were buying these super complex financial products they didn't even understand. Second, mortgage lenders, they completely stopped caring if borrowers could actually pay them back because they were just packaging up the loans and selling them off to Wall Street. And third, the rating agencies, the supposed referees in all this, they were just slapping AAA ratings on this junk. It was an absolute recipe for disaster. So when those subprime borrowers started to default, it wasn't just a housing problem, oh no. It was the first domino to fall in a very, very long line. It triggered the collapse of those mortgage-backed securities, which then inflicted massive losses on banks and investors all around the world. The chain reaction had begun, and absolutely no one knew how to stop it. And the result of all that? A complete meltdown of confidence. The credit window wasn't just closed, it was welded shut. Trust completely evaporated. Banks wouldn't even lend to each other. The entire global financial system just froze solid. And that is what plunged the world into the Great Recession. So, after seeing the kind of devastation this thing can cause, the most important question has to be, how can we see it coming? I mean, understanding the theory is great, but being able to read the signs in the real world, well, that's the whole ballgame. So let's look at the signals.
You know, it really boils down to two completely different worlds. It's night and day. On one side, you've got a generous market. Here, the only fear is the fear of missing out, FOMO. Everyone's chasing the same deals, asset prices are through the roof, and lenders are basically begging people to take their money. On the other side, you've got a cautious market. Here, the only fear is the fear of losing money. Capital is impossible to find, asset prices are in the gutter, and borrowers have to plead for a loan.
And here it is. This is the most crucial lesson, and I'm telling you, it goes against every human instinct we have. That sunny, optimistic, generous market is actually the most dangerous time to be investing. It's the stormy, pessimistic, cautious market that is packed with the greatest opportunity. And that really brings us to the ultimate lesson from Howard Marks. Superior investing isn't about finding the absolute best company in the world. It's about buying any decent company at a great price. And there is nothing that creates those bargain basement prices quite like the slammed shut phase of the credit cycle. So, I'll just leave you with this one question. Look at the world around you right now. Listen to the financial news. Think about the deals getting done. Based on everything we've just talked about, what do you see? Does it feel like that credit window is swinging wide open? Or can you maybe hear it starting to slam shut? You know, there's this really fascinating, and believe it or not, predictable cycle in finance where fortunes are made when things look their absolute worst. Today we're diving into the world of distressed debt. It's this incredible story of how good times actually sow the seeds for the bad, and how those bad times create massive opportunities for people who really get the pattern. And it all really boils down to this one simple mantra: good company, bad balance sheet. This right here is the key that unlocks the entire strategy. We're not talking about fundamentally broken businesses. Nope. We're talking about really solid companies that just got in way over their heads with too much debt. So here's how we're going to break this whole thing down. First up, we'll get to know the contrarian investor. Then we're going to follow the story of a bonfire, how the logs get stacked, what lights the match, and what happens when the fire is really raging. And finally, we'll see how the ashes of one fire actually create the seeds for the very next one. All right, let's jump right in. Who are these contrarian investors, and what in the world are they actually looking for? Okay, so think about your typical bond investor. They buy a company's debt for two pretty simple reasons. They want those steady interest payments, and they want their original investment back at the end. Well, in distressed debt investing, you can pretty much throw all of that out the window. The market is basically saying, hey, this company is in deep trouble, it's not going to pay you. So the bonds are trading for, pennies on the dollar. You're buying this stuff for a completely different reason. Which, of course, brings us to the million-dollar question. If the company isn't paying its bills, if you're not getting interest payments, why on earth would you buy its debt? What's the end game here? And the answer is actually pretty simple. It's all about ownership. See, when a company can't pay its debts and has to go through bankruptcy, the old shareholders, they usually get wiped out completely. And guess who steps up to take their place? The creditors. That debt they hold essentially transforms into equity, into ownership. They get the keys to the entire business. So you might be wondering, how do these incredible opportunities even happen in the first place? Well, and this is the crazy part, the fuel for this fire isn't created when everyone's scared. It's created when everyone is optimistic. The source material has a great name for this phase: stacking the logs. This whole process is just a masterclass in market psychology. Right after a crisis, it starts with caution. Everyone is risk-averse. But then, as the good times roll and very few companies default on their debt, investors, well, they start to forget what risk even feels like. They see the juicy returns from riskier bonds and they think, hey, this is easy money. That greed creates this massive demand, and you better believe Wall Street is happy to supply it. They start lowering their lending standards to finance weaker and weaker companies. And that, right there, that's what's called the unwise extension of credit. It's the logs being stacked one by one for a future bonfire. But here's the thing. Those logs, no matter how high you stack them, they're really just a pile of wood. They can sit there totally harmless for years. For a real crisis to kick off, you need that second essential ingredient, the igniter, the spark. Now, the igniter, that's the shock to the system. It could be an economic recession that just tanks company profits across the board. It might be a credit crunch where all the banks suddenly slam on the lending brakes.
Or it could be what they call a black swan event, something that comes completely out of left field and just shatters market confidence overnight. And history gives us a perfect example of this. Back in 1990, it wasn't just one thing, it was a perfect storm. You had the Gulf War kicking off, you had these famous, high-flying companies from the 80s suddenly going bankrupt, and then the very firm at the center of the junk bond universe collapsed. That was way more than enough to light the fire.
So you've got the logs of bad debts stacked sky high, and the igniter has just been lit. This is when the bonfire begins. This is the phase where pure fear takes complete control of the market, and a wild cascade of selling creates unbelievable bargains for the few people who are actually prepared for it. The speed of this psychological shift is it's incredible. It's like a switch just flips in the market's brain. One day, investors are falling over themselves to lend to risky companies. The very next day, they're terrified of catching a falling knife and wouldn't touch that same debt with a 10-foot pole. Everybody just runs for the exit at the same time, which, of course, only makes the whole problem worse. And this kicks off a brutal, self-reinforcing downward spiral. Defaults start to rise. Buyers, they disappear. Sellers, they're everywhere, and they're panicking, so prices just collapse. This triggers forced selling from funds that have to meet withdrawal requests. Selling just leads to more selling, and prices cascade downwards, often way, way below any reasonable assessment of what they're actually worth. This is the bonfire. But, bonfires don't burn forever. Eventually, the fuel gets used up, the fire starts to die down, and the conditions for a recovery begin to take shape. And that brings us to our final section, how the end of one crisis is really just setting the stage for the next cycle. So, as the panic finally dies down, you get a few brave investors who start picking through the wreckage, buying these assets for pennies on the dollar. The economy starts to heal, credit markets slowly creak back open, and those restructured companies get back on their feet. Default rates fall, bond prices recover, and those early investors, they make spectacular returns. And that success, that starts to attract everyone else back into the market. And here's the most crucial point to get. None of this is random. It's not luck. Each stage directly and predictably causes the next one in this perfect chain reaction. It just restarts the entire cycle all over again. And it all begins again with caution. Right after the fire, you have scared investors who will only accept the absolute highest quality debt. And of course, that high-quality issuance naturally leads to very, very few defaults. This makes the market feel incredibly safe and stable. But here's the irony. That very safety is what creates the next problem. After years of low defaults, investors become complacent. They completely forget what real risk feels like. And this complacency, combined with a renewed hunt for higher returns, opens the floodgates for lending to companies of lower and lower quality. And you know what happens next. Inevitably, when the economy hits a little rough patch, that whole mountain of lower quality debt starts to crumble, which leads to a big spike in defaults. Which, of course, has a chilling effect on the whole market, making investors terrified and risk-averse all over again. And just like that, the cycle is complete. We are right back where we started. And it's really important to see that this isn't just one single cycle. It's actually the result of 4 smaller cycles all interacting, kind of like gears in a complex machine. You've got the broader economy. You've got human psychology swinging back and forth between greed and fear. You've got investors' appetite for risk, and you have the availability of credit itself. They all turn together to create this one big, powerful master cycle. So the ultimate takeaway here is that this pattern of boom and bust, it's not a fluke, it's the norm. It has repeated for decades, and it will keep repeating. The logs for the next bonfire are always being stacked, one piece of unwise credit at a time. So the only real question left for us to think about is, where are we in the cycle right now?
When it comes to real estate, we're surrounded by all this comforting, timeless wisdom. These are the kinds of things you hear at family get-togethers, right? Phrases that make buying a property feel like the absolute safest bet in the entire world. But as we're about to see, that wisdom, well, it has its limits.
Oh yeah, you've definitely heard this one. It's the classic line about land, and it sounds so simple, so undeniably true. I mean, there's a finite amount of it, so its value has to go up forever, right?
And then for houses, this is the ultimate safety net. The idea that, hey, if your investment doesn't quite work out, at least you have a roof over your head. It's both an asset and a necessity all rolled into one.
Okay, this one is the big one, especially when the economy feels a little shaky. The idea that a real, tangible asset like property will hold its value, while the cash in your bank account is, well, shrinking, it's a really powerful argument.
Now look, there's some truth to all of these ideas. They're not totally wrong, but they can lull us into this false sense of security because they all completely ignore the single most important factor in any kind of investment.
And that's it. That's the whole game. It doesn't matter how great an asset is. If you overpay for it, you are setting yourself up to lose. And the one force that consistently tricks really smart people into overpaying for real estate is the market cycle.
So if paying the right price is everything, what is it that consistently fools people into paying the wrong one? It's the cycle. And what makes the real estate cycle so potent, so different from, say, the stock market? Well, it shares some DNA with other cycles, but it has one very, very special ingredient.
Like pretty much any market cycle, real estate is fueled by human psychology. Optimism leads to risk-taking, that creates a boom, and then it's followed by a bust. But the secret ingredient that cranks everything up to 11 is time. Specifically, the massive time lags that are just baked into the development process.
Just think about the core difference here for a second. In the credit market, a bank can decide to ramp up lending, and poof, that money hits the economy almost instantly. But a building, oh man, you've got feasibility studies, you got to buy the land, get all the permits, and then you have to actually build the thing. And what this means is that a project that was greenlit in a booming economy might not open its doors for years, potentially right in the middle of a brutal recession.
So this fundamental time lag, it creates this predictable, almost clockwork-like sequence of events. Let's just walk through how a boom actually and inevitably plants the seeds of its own destruction.
And what's so fascinating is how this whole thing becomes a self-perpetuating loop. It all starts at the bottom, in step 1, when times are bad and nobody is building anything. Then, the economy gets better in step 2, and demand starts to pick up. But of course, supply is tight, so in step 3, prices and rents start to shoot up. This triggers step 4, the frenzy, where developers and lenders, all driven by a fear of missing out, start a ton of new projects. And pretty soon, you get to step 5, cranes just fill the skyline. But because of those time lags we talked about, all these projects that were started in the good times, they end up opening their doors years later in step 6, creating a massive oversupply. And that glut, that's what causes the bad times that kick off the very next cycle.
Okay, so this predictable cycle brings us to a really fascinating problem in human behavior, where a whole series of what seem like perfectly logical individual decisions end up creating a completely illogical and disastrous outcome for the entire group.
All right, let me put you in the driver's seat for a minute. The market is hot. Your town clearly needs more houses. Let's say there's pent-up demand for about 100 new homes. You see a clear, obvious opportunity. So, what do?
And hey, you're not greedy. You're prudent. You know things can change, so you decide you're only going to meet a fraction of that demand. You'll build 20 homes. Seems like a very rational, even conservative business decision.
But here's the catch. You're not the only smart, cautious builder in town. There are 9 others, and they have all looked at the exact same data, seeing the exact same opportunity, and they've all had the exact same prudent idea that you did.
And boom, just like that, 200 new homes get built. 10 rational actors, each making what they thought was a conservative decision, collectively create a massive oversupply, flooding the market with double the number of homes it actually needed. This is how a boom flips to a bust, not because of one greedy person, but because of many rational ones.
And look, this isn't just some textbook theory. This chart of U.S. housing starts shows this exact thing happening in the real world. Just look at the period after the 2008 financial crisis. The bars that show new housing starts just completely collapse. By 2010, the raw number of homes being built was at its lowest level since the middle of World War II. It was a historic, unbelievable shutdown in construction.
But wait, as crazy as that chart looks, the raw number doesn't even tell the full story. The situation was actually way more dire, and the future opportunity far greater than you might think at first glance.
See that black line? That's where things get really interesting. It adjusts for population growth. Back in the 1940s, the U.S. population was about 131 million people. By 2010, it was over 300 million. So on a per-person basis, housing construction wasn't just low, it was at an unprecedented, off-the-charts minimum. This was a massive, flashing red signal that the second the economy started to recover, a severe housing shortage was absolutely inevitable. You know, even when you have data that's this clear, It's amazing how often people convince themselves that cycles are a thing of the past. In every single boom, you hear the same argument. It's different this time. But history has a pretty powerful counterargument. So to get the ultimate long-term view, some researchers found this incredible case study. They tracked the sale prices of a single, virtually unaltered house on a prime canal in Amsterdam, all the way from the year 1625. This lets us cut through all the noise and just look at one prime piece of real estate for nearly 400 years.
So what did they find after all that time? Get this. Between 1628 and 1973, the inflation-adjusted real return on this amazing property was just 0.2% per year. Barely anything. It held its value against inflation, sure, but it was definitely not the path to riches that so many people assume real estate is.
And as the economist Robert Shiller pointed out, the data clearly showed these long periods of growth, sometimes lasting 50 years, followed by long periods of decline. It didn't just go up and up forever. This kind of long-term, real-world data is just a powerful dose of reality against the popular idea that prices in so-called superstar cities can somehow defy gravity.
Okay, so what's the takeaway here? The goal isn't to become some kind of psychic who can perfectly predict the top or bottom of a cycle. It's really about understanding the forces at play, being able to recognize the signs of excess, and just having a clear sense of where we are in the whole process.
All right, so let's boil it all down. There are three big things that make these real estate cycles so powerful and so dangerous. First, those long time lags we talked about, which means supply and demand are constantly out of whack. Second, leverage. Real estate is almost always bought with huge amounts of borrowed money, and that just acts like a giant amplifier, making the good times feel great and the bad times absolutely catastrophic. And third, the supply is inflexible. You can't just take a few floors off an office building if demand dries up, which means an oversupply can last for years and years.
You know, there's this old, kind of cynical saying in the real estate world that just nails the painful reality of the cycle. It's not the original developer who built the project during the boom. It's not even the bank that had to foreclose on it during the bust. Often, the real money is made by the third owner, the investor who had the courage and the cash to buy that distressed asset from the bank and ride the next wave up.
So look, this whole framework, it's not a crystal ball, but it is a map. It helps you understand the terrain and the story that's unfolding. And that leads to the only question that really matters. Looking at the cranes in the sky, the headlines, and the mood of the market, where do you think we are on that map today?
Today, we're going to dive deep into the mind of legendary investor Howard Marks to really get a handle on the powerful, kind of hidden forces that drive market cycles. And here's the thing, it's not really about the numbers. It's about the very human drama of optimism, fear, and that herd mentality that shapes our whole financial world. So let's jump right in. You know, in theory, we're all taught that the market is this rational weighing machine, right? It calmly weighs all the facts and figures to figure out what something's really worth. But in reality, oh man, it's much more like a wild emotional pendulum. The market almost never just sits in that calm, rational middle. Instead, it's always swinging back and forth, from total euphoria on one side to absolute despair on the other, driven by forces that are way more primal than any spreadsheet. So what are these forces? Well, it all starts with what we call fundamentals. You can just think of these as the concrete events that are happening out there in the business world. You know, corporate earnings reports, cash flow, big economic trends. This is the hard data, the stuff that a purely logical weighing machine would focus on and only focus on. But as we're about to see, that's only half the story. And here is the other and frankly much more powerful half: psychology. See, this isn't about the events themselves. It's about how investors feel about those events. Are they feeling optimistic? Are they terrified? How much risk are they willing to stomach? This emotional layer, it takes that raw data from the fundamentals and just cranks the volume up to 11, creating the crazy swings we see in the market. It's the human element, and it is the real engine of the cycle. Just look at how these two forces play off each other. It's a powerful upward spiral. So it starts with a few good things happening: good earnings, a strong economy. And that, in turn, improves investor psychology. People get optimistic, right? Their standards for what a good investment looks like actually get lower. That new willingness to take on more risk, that pushes asset prices higher. And what do rising prices do? Well, they create a feedback loop. They make investors feel like geniuses, making them even more optimistic, which reinforces that positive psychology, and the whole thing just spirals higher and higher. So let's use this framework to really dissect the first major phase, the bull market. We're going to look at the anatomy of that upward spiral as it builds and builds to a peak that is way more dangerous than it looks.
Howard Marks breaks this down into 3 really simple but brilliant stages. Okay, so stage 1. Only a tiny group of really insightful people think things are going to get better. The general mood is still pretty down and assets are cheap. Then comes stage 2. The improvements become obvious. Most investors start to catch on and prices begin to really move up. And then you get to stage 3. This is the danger zone. This is when everybody is totally convinced the good times will literally never end. Logic is just out the window, replaced by pure euphoria.
And this quote, wow, it just brilliantly captures the whole thing, doesn't it? This single sentence tells you almost everything you need to know about market cycles. The wise investor, they act in stage 1, when things look awful, but the potential is huge. The fool? Well, the fool waits until stage 3, when the good news is everywhere, optimism is off the charts, and prices reflect a level of perfection that just can't last. Warren Buffett has his own take on the exact same idea, and it's just as sharp, maybe a little more blunt. The innovator, that's the perceptive person in stage 1. The imitator, that's the crowd, the herd that jumps in during stage 2. And the idiot? Well, that's the person who finally buys in at the very peak in stage 3, driven by that fear of missing out, right as the whole cycle is about to turn over.
All right, so now let's look at the other side of that big pendulum swing, the bear market. It's basically the perfect mirror image of the bull, and it's driven by the exact same psychological forces, just in reverse.
The stages here are a perfect inversion. It starts with just a few thoughtful investors who realize, hey, things are getting overheated and people are ignoring some serious risks. Then, in stage 2, the bad news becomes obvious to most people, and the market starts its slide. And finally, we hit stage 3, total despair. Now, everyone is convinced the decline is permanent, and things can only get worse from here.
And here is the absolutely crucial point. The fool in the end doesn't just make one mistake. They make 2. They buy at the top when everyone's euphoric, and then, driven by that exact same herd instinct, they sell at the bottom when everyone's in a panic, often after the worst of the losses have already happened.
The extremes of these cycles, the top and the bottom, are where things get really fascinating. This is where rational thought just gets completely thrown out the window. Let's dig into the psychology of these moments.
So a bubble, it isn't just a high price. It's a belief system. It's that moment when the market collectively decides that the old rules about valuation just don't apply anymore. The core belief becomes, there's no such thing as a price that's too high. At that point, any link between the price you're paying and the actual fundamental value of the asset, it's just gone. It's pure investing based on momentum and emotion.
So what pushes people into a bubble like that? It's a powerful psychological force called capitulation. This is what happens to that investor who was resisting the trend, the one who knew it was crazy. But after watching everybody else get rich, the pain of missing out just becomes too much to handle. They give up, they throw in the towel, and they buy in, usually right at the peak, officially becoming the fool in the end.
This quote from Charles Kindleberger just nails the emotional trigger for capitulation. It's not just about greed, it's about envy. Watching your friends and your neighbors make what looks like easy money on something you were smart enough to avoid, well, it can be psychologically unbearable. And it's a force so powerful it can override even the most brilliant minds on the planet.
And if you need proof, look no further than Sir Isaac Newton. Yeah, that Isaac Newton. During the famous South Sea bubble back in 1720, Newton initially invested, and being a genius, he recognized the mania for what it was. He got out early, and he pocketed a very tidy profit. He was the wise man acting in the beginning. He even famously commented on the insanity all around him. He said, "I can calculate the motions of the heavenly bodies, but not the madness of the people." He saw the irrationality with perfect mathematical clarity. He knew the market wasn't being driven by logic anymore. It was pure, raw emotion. But then, it happened to him. He just couldn't stand it. He sat on the sidelines and watched his friends and his peers who had stayed in the bubble continue to make absolute fortunes. The psychological pressure was just too much. He capitulated. He jumped back in with both feet at the absolute peak of the market and ended up losing a fortune, way more than he had made in the first place. If this can happen to one of the most brilliant minds in all of human history, trust me, it can happen to anyone. Okay, so why does all of this matter? What's the point? Well, because where we are in the market cycle has a direct and massive
impact on your future returns. This is where all that theory smacks right into reality. Let's start with the baseline. When the market is right in the middle of its cycle, emotions are pretty balanced, valuations are fair. In this kind of environment, the distribution of what might happen next is, well, normal. You can probably expect average returns with a roughly equal shot of doing a little better or a little worse. Nothing crazy. Now look at what happens at a cyclical high, the very peak of that bull market. The market has already priced in every last drop of optimism and good news. From this point forward, the probability for your future returns shifts dramatically. The most likely outcomes now are low or even negative. Your potential to make money is tiny, and your risk of losing money is incredibly high. And finally, let's look at the bottom, when things feel the worst. At a cyclical low, pessimism is absolutely everyone. Everyone is convinced things will only get worse. But because all that bad news is already baked into the prices, the outlook for future returns is the complete opposite of the peak. The probability of good things happening shifts way over to the right. Your potential for high returns is at its absolute greatest, and paradoxically, your long-term risk is actually at its lowest. So, here's the bottom line. These cycles are going to continue. The pendulum will keep swinging from euphoria to despair and back again. History tells us, screams at us, that this is inevitable. So the only real question left is, now that you understand the psychology of the crowd and those 3 stages, where are you going to choose to act? All right, today we're jumping right into the brilliant mind of legendary investor Howard Marks. We're going to unpack one of the most powerful and often misunderstood forces in finance, the market cycle. So let's kick things off with the big question, the one that every single investor has to wrestle with. We all want to put our money to work, right? To benefit from what's coming next. But here's the catch. The future is a complete unknown. So how in the world do we make smart decisions when we're basically flying blind? And boom, right there, this quote from Howard Marks just nails the solution. See, the answer isn't about trying to get a better crystal ball. It's about knowing where your feet are planted. It's about developing this really keen sense of where the market is right now and what that tells you about what might happen next. So here's the game plan for today. First, we're going to talk about why trying to predict the future is usually a fool's errand. Then, we'll get into the real meat of it, understanding the natural rhythm of market cycles. From there, we'll get super practical with a guide to taking the market's temperature. Check out some wild stories from history, and then wrap it all up by figuring out how you can actually use this stuff for your own portfolio. All right, first up, the futility of forecasting. Or, as I like to call it, the problem with crystal balls. You know, Howard Marks is super clear about this. He basically says that almost nobody can consistently predict the future. If you look at the track record of most professional forecasters, well, let's just say it's not great. So if forecasting is off the table, what do we do? The alternative is to stop trying to see the future and instead get really, really good at understanding the present. And that idea of understanding the present, well, it leads us directly to our second section. This is all about getting a feel for market cycles, for the natural rhythm of the market. So take a look at this. It's the perfect way to visualize the whole idea. Just think of a pendulum. It doesn't just swing to the middle and stop, right? No way. It swings from one extreme, passes right through that average point, and keeps going all the way to the other extreme. That is the fundamental pattern we have to burn into our brains. So what are the big rules here? What defines these cycles? Well, first, history doesn't repeat, but man, does it rhyme. The same themes pop up again and again. Second, things go up and things come down. It's just a law of nature, especially when you throw messy human emotions into the mix. And this is the big one. These swings almost always push to crazy extremes before they finally turn around and swing right back past the middle. Now let's talk about financial markets specifically. What's pulling the strings? Well, sure, you've got the underlying economy and company profits, but the real engine, the thing that sends the cycle into overdrive, is us. It's human psychology. It's our habit of completely overreacting to news, good or bad. It's how our view of risk can swing from what risk to the world is ending. And that makes prices swing from reflecting only good news to reflecting only bad news. Okay, that psychological piece is just, it's everything. And it brings us perfectly to section 3, how do we actually take the market's temperature? This is where we get down to brass tacks. So Marx breaks this down into 2 key things we need to do. First, there's the math,
the quantitative part. We look at valuations. Are things cheap or expensive compared to history? That's our objective data point. And second, there's the mood, the qualitative part. We just look around. We pay attention to how other investors are acting and feeling. And this checklist, this is your practical toolkit. It's how you actually gauge that mood. So in a hot, risky market, what do you see? Everyone is desperate to buy, the news is all sunshine and rainbows, money is super easy to get, and prices are through the roof, which, of course, means your potential future returns are probably pretty low. A cold market? It's the exact opposite. As Marx famously says, if you find yourself ticking a whole bunch of boxes in that left column, you better hold on to your wallet. And this Warren Buffett quote just hits the nail on the head, doesn't it? It's all about being a contrarian. When everyone else is being reckless and greedy, that is your bright, flashing sign to be careful. And when they're scared out of their minds, selling everything that isn't nailed down, well, that's your cue to get aggressive.
Okay, so what does this actually look like in the wild? Let's get into section 4 and look at some real-world lessons from the extremes. A couple of classic case studies in pure greed and pure fear.
Let's rewind to the dot-com bubble. I mean, the warning signs were flashing everywhere. You had Alan Greenspan way back in '96 talking about irrational exuberance. By 2000, the market had more than doubled from there. You had books coming out with titles like Dow 36,000, and the valuations were just insane. The PE ratio for the S&P 500 hit 33, which is double its long-term average. All the check marks were deep in that hot market column. And you know what happened next? A brutal, painful crash. You know, Marx pointed out at the time that it was like a lottery ticket mentality had completely taken over. People weren't buying stocks based on fundamentals. They were buying a concept, a dream. And he said that while greed and fear usually run the show, sometimes the biggest driver of all is just the fear of missing out. Good old FOMO. And that was never, ever more true than in the late 90s. Now, let's flip the coin. Compare that mania to the absolute bottom during the 2008 global financial crisis. It is a perfect mirror image. The greed of 2000 was totally replaced by paralyzing fear. The belief that it's different this time became the belief that the whole system is going to collapse. Carefree attitudes became extreme risk aversion. The market literally swung from being able to see only positives to being able to see only negatives. And the fallout from that panic? Well, the numbers speak for themselves. This is the brutal, hard reality of 2008. Look at that. There was just nowhere to hide. Stocks, junk bonds, loans, everything got absolutely hammered. This is what happens. This is the bill that comes due after the party in the hot phase gets out of control. So what's going on here? There's this really crucial idea championed by George Soros called reflexivity, and it's a bit of a mind bender. The idea is that investors aren't just passive observers, their actions actually change the reality of the market. Think about the housing bubble. The widespread belief that home prices only go up made banks create looser and looser loans, which let more people buy houses, which pushed prices up even more, which proved the original belief was right. The belief created its own reality for a while. All right, we've seen the theory, we've seen the history. Now for the most important part. How do we actually use this? Let's get into our final section, positioning your portfolio. This is about moving from just assessing things to actually doing something.
First things first, we have to know what game we're playing. Marx calls it balancing the twin risks. The first one is easy, right? The risk of losing money. We all get that. But the second one is sneakier. The risk of missing opportunity. It's the danger of being so cautious that you miss out on all the gains. You can totally get rid of one of these risks, sure, but you'll do it by taking on 100% of the other. The whole trick is finding the right balance.
And here it is. This is the simple, actionable game plan. Your entire approach should change based on the market's temperature. When the market is high and hot, when everyone's euphoric, your number one job is to manage the risk of losing money. You play defense. But when the market is low and cold, when there's blood in the streets and everyone is terrified, your job flips. You need to focus on not missing the opportunity. That is your time to play offense. You know, people are always trying to simplify this. They ask, what inning are we in? And it sounds smart, it's a tempting way to think about it, but Marx points out a huge flaw in that thinking. A baseball game always has 9 innings. It's a rule. But a market cycle, who knows? It could be 7 innings, it could be 12, it could be 20. We just don't know. We can get a feel for the character of the game, but we can never, ever know exactly when it's going to end. So we'll end with a question for you. This is the homework. Using this framework, taking the market's temperature as you see it right now, which of those twin risks do you think deserves more of your attention? Is it the risk of losing your shirt, or is it the risk of missing the boat? Your answer to that question is really the first step to mastering the market cycle.
Let's just start with that quote for a second. That's from the legendary investor Howard Marks. And it's a pretty bold statement, right? It perfectly kicks off what we're about to unpack today, a really powerful way to think about not just surviving, but actually thriving in the wild world of market cycles. Welcome to The Explainer. Today, we're diving deep into the core ideas from Howard Marks' incredible work, Mastering the Market Cycle. We're going to break down his framework for using cycle analysis to get a real edge. This is all about moving from being a passive victim of the market's mood swings to becoming an active strategist who can actually navigate these tides.
So here's our game plan. We'll kick things off with a fascinating story of how this whole framework even came to be. Then we'll build out the toolkit with its 6 key pieces. After that, we'll dive into the 2 master skills, positioning and selection. And finally, we'll see how the absolute best investors combine them for truly amazing results.
All right, so believe it or not, our story doesn't start in some stuffy Wall Street boardroom. It starts with Howard Marks waking up in a hotel in India, and it was there that he had this sudden aha moment, this flash of insight that just clicked a bunch of different ideas together into one powerful concept.
You see, months before, he was in Beijing and had just scribbled some diagrams on a whiteboard to explain something. Now, sitting in India, those images came rushing back and connected with that quote we started with. And he had this epiphany. Good timing in investing, well, it doesn't have to be just dumb luck. It can actually be the result of skillfully figuring out where we are in a cycle and then positioning your portfolio because of it.
So this big aha moment led him to get really structured about his thinking. He basically broke down the whole art of managing a portfolio into 3 key pairs of ideas. And these 6 components, they make up the essential toolkit we're going to explore. They're the building blocks for getting that investor's edge.
First up, we've got the 2 main levers an investor can pull. On one hand, you've got cycle positioning. That's the big picture, the macro call, based on the market weather report. How much risk should you be taking on? And then you have asset selection. That's the micro stuff. Which specific stocks or bonds are you actually going to buy or sell? Now, for each of those decisions, you've got to pick a stance. Are you going to be aggressive, lean into risk to try and capture more of the upside? Or are you going to play defense, pull back a bit, and really focus on protecting your capital when you think there might be trouble ahead? And the final pair, well, these are the 2 forces that ultimately decide how everything turns out. You've got skill, that's your repeatable process, your edge, the thing that lets you be right more often than not over time. And then there's luck. That's the wild card, just pure randomness that can make a great decision look bad or a terrible decision look brilliant, especially in the short term.
Okay, let's see how this all comes together by really digging into that first master skill, cycle positioning. This is the art of dialing your portfolio's risk level up or down, its aggressiveness or defensiveness, based on how you're reading the market cycle.
Okay, think of this bell curve as our starting point, our blank canvas. This is what the market's returns probably look like if you just did nothing special, right? Like if you just bought an index fund and walked away. Most of the time, the results are going to be somewhere there in the middle, near the average.
But let's say your analysis tells you that things are looking good. The economy's humming, investors aren't too crazy, and prices seem reasonable. You decide to get aggressive. And look what happens. You stretch out that probability curve. You're basically turning up the volume on your portfolio, which means you have the chance for way bigger gains, but, and this is crucial, also way bigger losses.
And this is the payoff. If you were right, and the market does rally, your aggressive stance means you capture so much more of that upside. You don't just keep up with the market, you blow past it. That's the reward for timing your aggressiveness correctly.
But what about the flip side? What if your analysis is telling you to be nervous? Maybe the economy's looking tired, everyone's euphoric, and prices are through the roof. Well, then you get defensive, and that squishes the curve together. You're reducing your risk, limiting how high you can fly, but also, and this is the key, limiting how far you can fall.
And this is such an important point. If you were right to be cautious, and the market does fall off a cliff, your defensive strategy is actually a winning strategy. You outperform everyone else by losing less. In a bear market, that's how you win the game.
But there's always a but, right? Here's the risk.
If you turn defensive at the wrong time, if you get cautious just as the market decides to have another huge rally, you're going to underperform, maybe by a lot. You miss out on all those gains. So it just goes to show, positioning is a powerful tool, but your timing has to be on point.
All right, let's switch gears and talk about the other master skill, asset selection. This is all about what's happening inside your portfolio. It's the ability to pick more winners than losers, and really, it's all about creating what Marx calls asymmetrical results.
So on the left, you've got an investor with no real selection skill. Their returns just kind of mirror the market. But the one on the right, this is fascinating. This is negative skill. This is someone whose choices are somehow consistently worse than random. They actively pick more losers and do worse than the market, both on the way up and on the way down.
So what's the whole point of this selection game? It all comes down to one word, asymmetry. It's about building a portfolio where your potential to win is just way, way bigger than your risk of losing. It means your winners win more than your losers lose. That's pretty much the holy grail of investing.
Now, this is where it gets really interesting. Look at how skill creates that asymmetry, no matter what your general stance is. The skilled, aggressive investor on the left, yeah, they go up more than the market, but their smart picks mean they don't fall as much as you'd expect. And the skilled defensive investor? They still protect you in a downturn, but their clever selections let them capture more of the upside than you think. It's the best of both worlds.
So that brings us to the ultimate question. What happens when a truly superior investor masters both of these skills? What does that even look like?
And here it is. This graph shows you the best of all worlds. This is the investor who isn't always aggressive or always defensive. No, they're like a chameleon. They skillfully adapt their risk exposure by getting the cycle timing right, and they consistently pick assets that give them that beautiful asymmetrical return profile.
And this is why truly great investors are so incredibly rare. I mean, anybody can ride a bull market up, but it takes an unbelievable combination of insight and discipline to get the big picture timing right and nail the individual asset picks over and over again.
Howard Marks borrows this incredible idea from the detective who caught the Son of Sam killer. You can't control luck, you can't force a lucky break, but what you can do is all the hard work, the analysis, the positioning, so that when luck does show up, you are perfectly set up to take full advantage of it. You prepare to be lucky.
You know, the big takeaway here goes way beyond just your investment portfolio. This whole framework of understanding cycles, of knowing when to be aggressive or defensive, of honing your skill, it's a powerful mental model you can use anywhere. In your career, in your relationships, whatever. So the final question I'll leave you with is this. Where are the cycles in your own life, and how can you start preparing to be lucky?
Have you ever had that daydream? You know, the one where you sell everything you own at the absolute peak of the market, right before it all comes crashing down. Or maybe you swoop in and buy at the very bottom. It's pretty much the ultimate fantasy for any investor, right? Well, today we're going to dig into the wisdom of the legendary Howard Marks to figure out if timing the market is a brilliant strategy or if it's just a really, really dangerous trap. So let's just ask it straight up. Should you try to time the market? It's the million-dollar question. I mean, the dream of selling at the top and buying at the bottom, it feels like the ultimate investing cheat code. But is it just a fantasy, or is this a skill you can actually, master? Well, here's where it gets interesting. According to Howard Marks, the answer is this fascinating paradox. On one hand, he says, yeah, it's perfectly reasonable to try and use the market cycle to your advantage. But on the other hand, he warns that it's one of the absolute hardest things an investor can possibly do. So, how do we make sense of that? Let's break it down. All right, here's our game plan. We're going to walk through 5 key ideas from his work. We'll start with the allure of timing, why it's so tempting. Then we'll face the peril of being early. After that, we'll get into a simple framework for finding the market extremes, understand why patience is the real superpower here, and finally, we'll land on what the ultimate goal of all of this really is, just plain survival. Okay, first things first. Let's just admit it. The pull is real. The idea of skillfully weaving in and out of the market's ups and downs, it's almost impossible to resist. It feels like the pinnacle of being a smart investor. And here's the thing. Howard Marks himself, he gets it. He validates that instinct. He's not telling you to just give up on the idea. He actually believes it's a perfectly reasonable goal. The key here isn't to abandon the attempt, but to really, fundamentally understand the game you're playing. And this is the big mental shift you have to make. Marks argues that successful market timing has absolutely nothing to do with having a crystal ball. You cannot predict the future. The real skill is actually more like reading a map. It's all about knowing exactly where you are today. Because if you can get a good sense of your current position in the market cycle, you can start to tilt the odds of success dramatically in your favor. But here's the catch. Even if you get your map reading right, there's this massive hidden trap waiting for you. And it's a danger so powerful that it can derail even the most brilliant investors. And it has everything to do with being just a little too early. This quote, this is one of the most important sayings in all of investing, and it's the heart of this entire problem. Let that sink in for a second. If you're right, but you're right too soon, the market can punish you as if you were completely, totally wrong, and the consequences can be disastrous. The dot-com bubble is the perfect, painful example of this. Back in the mid-90s, tons of smart investors saw the insanity for what it was and correctly called it a bubble. So naturally, they got defensive. The problem? The market kept rocketing higher for 3, 4, even 5 more years. These cautious investors looked like total fools. They were losing clients, they were underperforming, their careers were on the line. And yeah, they were eventually proven right, but that's a huge if they managed to survive the absolute agony of being early. And that right there is the psychological trap. The pain of being early, of watching everyone else get rich while you're sitting on the sidelines, it becomes unbearable. It can get so intense that it forces you to just give up, to capitulate, to throw in the towel and buy in right at the top, just moments before the crash you predicted finally happens. It is the ultimate investing tragedy. So, okay, if being early is a death trap, then how in the world do you navigate this? Well, this is where Howard Marks gives us a really simple but incredibly powerful framework for understanding when to act and, just as important, when not to. Let's break this down. See that straight line in the middle? Think of that as an asset's intrinsic value, what it's fundamentally worth. But the market, well, the market is rarely rational. It's emotional. It swings back and forth like a pendulum, from wild, crazy optimism where assets get rich to deep, dark pessimism where they become cheap. And most of the time, it's just kind of hovering somewhere in that murky middle. And this right here is the core of the whole strategy. The only time you can really act with any confidence is at the extremes. When an asset is obviously screamingly cheap or ridiculously absurdly rich, the path forward is pretty clear. But in that huge middle ground, it is all ambiguity and guesswork. Trying to be a hero when things are fairly priced is a really low probability bet. This is exactly why Marx calls that middle ground a trap. It just tempts you to overtrade to try and be cute and make all these small, clever little moves. But your odds of being right are lower, the potential profits are way smaller, and you're just far more likely to make a costly mistake. You know, sometimes the most profitable action you can take in the middle is no action at all. So that brings us to the next big point. If you can really only act at the extremes, then the most important skill you can have isn't complex analysis or forecasting. No, it's something else entirely. So how often do these perfect opportunities at the extremes actually come along? Well, Howard Marks, one of the greatest investors of his generation, he looked back at his first 48 years in the business, and the number of times he felt confident enough to make a major decisive call on the market cycle was just 5. That's it, 5 times in nearly half a century. What this tells you is that market timing isn't a game you play every month or even every year. It's a game of immense strategic patience. And get this, even on those 5 rare occasions, think about his mindset. He wasn't acting with supreme chest-pounding confidence. He says he was filled with uncertainty and trepidation. He knew that even when the odds were massively stacked in his favor, he could still be wrong. This profound humility, this acceptance that there are no sure things in investing, it's absolutely crucial. You know, it's kind of like being a surfer. You can't create the perfect wave. All you can do is wait for the ocean to deliver it. The market is exactly the same. It decides when the great opportunities will show up. Your job isn't to paddle frantically after every little ripple. It's to sit patiently on your board, conserve your energy, and just be ready. So when that perfect wave finally comes, you can act with discipline and conviction. All of this leads to a really profound reframing of what it even means to be a successful investor. It's not about being the best forecaster or having the hottest stock picks. It's about something much, much more fundamental. And to really drive this final point home, Marx often uses this incredible quote from the financial historian Peter Bernstein. He wrote that the trick isn't being the hottest stock picker, because those victories are temporary. The real trick is just to survive. Staying in the game long enough for your strategy to actually work, that is everything. And surviving requires what Bernstein called a strong stomach for being wrong. Because you will be wrong. It's not a personal failure, it's not bad luck, it is an inevitable part of investing in an unknowable future. He says it's part of the franchise. And accepting that fact is what allows you to endure those painful periods, like being too early, without giving up and blowing up your entire strategy. So the question I want to leave you with is this. Is your strategy built for prediction or is it built for survival? Are you betting on a fragile crystal ball or are you building a fortress designed to stand for decades, making sure you're always there to invest another day? Thanks for joining this explainer.
Hello and welcome. We all chase success, right? In investing, in our careers, in life. But what if I told you that actually getting it is often the very first step toward losing it all? Today, we're diving into a powerful, kind of counterintuitive idea, how winning can be the very thing that sets you up to fail.
This quote from the legendary investor Howard Marks, it just nails the paradox we're unpacking today. It suggests that success and failure aren't these final destinations. Nope, they're just part of a continuous cycle, where one thing literally causes the other. It's a really profound idea, and once you see it, it kind of changes how you look at everything.
But why, though? Why does this happen? What is this invisible force that seems to pull the champions right back to the pack? That is the central question we are investigating. And the answer, well, it starts in a pretty surprising place.
So, our investigation, it doesn't begin in the market or on some complex spreadsheet. It begins right here, inside our own heads. Because this cycle, it turns out, gets its start with how success changes the way we think and the way we behave.
You know, success feels absolutely fantastic. It validates our choices, it makes us feel like a genius. But it has this psychological dark side. It can make you rich, sure, which can, ironically, kill your motivation. It makes you confident, which can so easily bleed into complacency. It literally alters the very behaviors that got you the win in the first place.
And this really illustrates the razor-thin edge we're talking about. On one side, you've got healthy confidence, the kind you need to back an unconventional idea or to hold on when a position goes down at first. But success can tip that confidence over into full-blown hubris. That's when you start assuming you're infallible, that you know more than the entire market. You stop insisting on that critical margin of safety that protected you all the way up.
And boy, can success teach us some truly dangerous lessons. You start to think, hey, making money is easy. Or risk, that's for other people. Or maybe you believe that a small idea that worked once can just be scaled up forever. Or, one of the most dangerous, that being a genius in one thing makes you a genius in everything. Every single one of those beliefs is a trap waiting to be sprung. You know, the economist Henry Kaufman just absolutely nails this danger. It's not just the beginner who gets wiped out. It's also the expert who gets so puffed up by their own success that they become convinced they've mastered the game and just can't possibly be wrong.
Okay, so we've seen how our own psychology can sabotage us. But the cycle doesn't stop there. Even if you manage to conquer your own hubris, a winning strategy faces another incredibly powerful enemy, its own popularity.
So this is the crucial point. True bargains, we're talking the investments with the greatest potential, they're almost always found in things that are undiscovered, disrespected, or just totally misunderstood. They're cheap because they're unpopular. But the second a strategy or an asset gets successful, it gets noticed, it becomes popular. And that very popularity is what bids up the price, completely destroying the bargain that was there in the first place.
And this isn't random, it follows this really predictable life cycle. Okay, step 1. An idea is unusually profitable. Step 2, that success attracts a flood of capital from the crowd. Then step 3, pretty soon the strategy is overcrowded, with everyone chasing the exact same thing. And finally, step 4, with no bargains left, the returns completely collapse. Sometimes they even go below average for the poor folks who showed up late to the party.
Now, I know this might sound a bit abstract, but there is a perfect, almost legendary case study of this whole principle in action. And it involves an iconic magazine cover that perfectly captured popular opinion at the absolute worst possible moment.
Get this, in August 1979, after a really brutal decade for the stock market, Businessweek published its cover story, The Death of Equities. It was the ultimate signal of pessimism. So what happened next?
Well, just 3 years later, one of the greatest bull markets in history kicked off. By the time the market peaked in March of 2000, it has soared over 14 times higher than it was when that article came out. Incredible.
Oh, but wait, it gets even better. If you actually include dividends, the total return for an investor who bought stocks right when they were declared dead and just held on was a staggering 28 times their money. The reward for going against the crowd was just immense. This whole story perfectly shows the difference between two levels of thinking. First level thinking, it's simple. It's linear. It just says, stocks are doing poorly, so they'll probably keep doing poorly. But second level thinking is much more insightful. It says, stocks are doing poorly, which has made them unpopular, and therefore cheap, which means they are primed for great performance tomorrow. See the difference?
All right, so this cycle doesn't just apply to markets. It happens inside individual companies too. And there is no better example of this rise and fall and then rise again than the story of a true corporate giant.
Let's talk about Xerox. I mean, back in the 1960s, they were the definition of a titan. They had a complete monopoly on dry copying that just seemed unbreakable. But just as we've been seeing, their incredible success carried the very seeds of their own undoing.
So what happened? Well, that success led to a whole series of predictable, really damaging behaviors. The company got complacent, fat and happy. It became bureaucratic and slow. It just stopped innovating. And maybe most importantly, its massive profit margins were like a giant flashing neon sign inviting competitors to come and attack.
But remember, the other half of our paradox, failure contains the seeds of success. So by the early 2000s, Xerox was in deep, deep trouble. But that crisis, that failure, it forced them to change. The company regained its motivation, it shed all that bureaucracy, it restructured its debts, and it refocused the business. The pain of failure was actually the catalyst for its recovery.
Okay, we have seen this cycle in our own psychology, we've seen it in the market, and we've seen it in companies. So, the big question now is, what do we do with this knowledge? How do we actually put this powerful idea to work for ourselves?
If there is one key takeaway for achieving really exceptional results, it's this: you have to get there early. The greatest opportunities are always hiding in the areas that are still undiscovered by the crowd, where there's no competition and where things are still cheap precisely because they're not yet popular.
And look, this is not some newfangled theory. Over a century ago, we're talking 1899, Andrew Carnegie's partner Henry Phipps wrote this. He saw that good times create bad times just as surely as a pendulum swings. The pattern is timeless. The real question, like he asks, is do we have the sense to actually use that knowledge?
So let's just nail down this definition. What is the cycle in success? It's the process where success creates the very behaviors and the market dynamics that cause failure. And on the flip side, it's how failure forces the painful changes that eventually lead back to success. So, the most important point is this. You have to fight that natural human urge to believe that good times will last forever. In fact, you should be the most skeptical when things seem the easiest. Because it's the good times that encourage the very risks, the unwise decisions, the excessive debt, the overconfidence that pave the road for the bad times to come. And that leaves us with a final, provocative question for you to think about. As you look around your own world, your investments, your industry, maybe even your career, what's the thing that everybody loves today? What's popular, crowded, and expensive? And maybe more importantly, what's being ignored? Because that might just be tomorrow's bargain.
All right, today we're going to tackle a concept that I promise you, once you really get it, it's going to change the way you look at markets forever. We're diving deep into the work of the legendary investor Howard Marks to answer a really simple but profound question. Why do markets always move in waves? And why is that pattern basically unbreakable?
And boom, right here. This is the core idea of our entire explainer. I mean, listen to this. Howard Marks isn't just saying, hey, cycles happen. No. He's arguing they are an absolute permanence, a fact of life as long as human beings are involved. Now, that is a bold, bold statement. It completely flies in the face of decades of so-called expert predictions, and really, it's the foundation for everything we're about to get into.
So, here's how we're going to break this down. First, we're going to look at the unbreakable pattern of the cycle itself. Then, we'll get into the really dangerous belief that we can somehow eliminate it. After that, we'll dig into the human psychology that actually makes these waves inevitable. We'll trace that emotional roller coaster from total euphoria all the way down to fear. And finally, this is the good part, I'll show you how you can turn all this knowledge into your own secret weapon as an investor.
All right, let's kick things off with the fundamental truth here. Cycles aren't some kind of bug in the system. They're a feature, you know? They are a repeating, unbreakable pattern that has defined how markets and economies work for centuries. I mean, just think about it for a second. The Roaring '20s, right? The dot-com boom. Every single era of excess, every single one, has had those same whispers in the background. Oh, but this time it's different. People point to new tech, or brilliant new policies, or some kind of new paradigm in economics. And what happens? Every single time, without fail, the cycle comes roaring back, and usually it comes back with a vengeance. And that brings us right to the great myth, the really seductive and unbelievably dangerous idea that this time, we've finally figured it out. We've cracked the code, we've tamed the business cycle for good. Just take a look at this. The date, 1996. And this wasn't some fringe opinion piece, okay? This was the Wall Street Journal reporting on a consensus. In fact, get this, 51 out of 53 top economists they surveyed agreed with this. The experts, the smartest people in the room, were absolutely convinced the game had changed.
So, what happened next? Well, that claim that the cycle was tamed, just a few years later, bam, the dot-com bust happens, wiping out literally trillions in wealth. And it didn't stop there. Not long after that, we got the global financial crisis, a collapse that caused millions of people their homes and their jobs. I mean, this just shows you the very real, very painful danger of believing the cycle is dead.
And hey, just in case you're thinking this is, a modern problem, it's not. This isn't new at all. Go back to the late 1920s. Statements just like this one were everywhere. You had respected leaders, presidents of major companies, even the president of the United States himself, proclaiming a new golden age of permanent prosperity.
The timing, it's just so tragically ironic you can't make it up. These proclamations of endless good times, they were being made on the literal doorstep of the Great Depression, the single most devastating economic crisis of the entire 20th century. It is just such a stark reminder of how incredibly fast, the tide can turn.
You'd think we'd learn, right? But nope. The same belief came roaring back again, just repackaged for the 2000s. And this time, it even got a fancy, official-sounding name, the Great Moderation. The whole idea was that, these new financial tools like derivatives and smarter monetary policies had basically gotten rid of major risk. It was this widespread belief that we had engineered our way out of the cycle. Spoilers, we hadn't.
So here's the bottom line on all this. Howard Marks calls these 4 words, "it's different this time," the most expensive and dangerous words in the entire business world. And he's right, because those are the words that give us permission to ignore history, to justify crazy extremes, and to set the stage for the inevitable crash. You gotta remember those words.
Okay, so if it's not about new tech or brilliant policies, what gives? What is the real reason these cycles just keep happening? Well, the answer has absolutely nothing to do with spreadsheets or algorithms, and everything to do with what's going on right inside our own heads. It's time to dive into the human element.
I love this quote from the physicist Richard Feynman. It just perfectly captures the heart of the whole thing. He said, imagine how much harder physics would be if electrons had feelings, right? The laws of physics work because electrons don't get greedy, they don't get scared. But markets? Oh, markets are a totally different beast, precisely because they are made up of us.
Let's just break this down, because it's super important. On one hand, you have science. It's governed by fixed, unchangeable rules. You do A, you get B. Every time. But economics, that's all about people. And because people are emotional and unpredictable and, let's be honest, often totally irrational, the results are always variable and, this is the key, cyclical. You just can't predict what millions of emotional humans will do the way you can predict what one little electron will do.
So if you take one thing away from this section, let it be this. A market is not some abstract machine. It is nothing more than the sum total of millions upon millions of human decisions. And those decisions are driven by fear and by greed. Our tendency to get totally euphoric at the top and completely despondent at the bottom, that isn't a glitch in the system, it is the system.
Okay, so what does this human element actually look like in action? Let's trace that emotional journey step by step that creates the massive booms and the really painful busts that define a market cycle.
It all starts with something really simple. A feeling. Optimism. People start feeling good about the future, so what do? They spend a little more, they save a little less. This starts to fuel what's called a sentiment cycle. Then, to try and juice their returns, people and companies borrow more. This kicks off a credit cycle, and things start getting a little more precarious. But hey, in the good times, who's really worried about risk, right? This collective overconfidence just fuels this frenzy of overexpansion. Companies build new factories and stock up on inventory for a future that, spoiler alert, isn't going to last. Each step just feeds the next one, pushing the whole cycle higher and higher and higher.
When you really boil it all down, it comes down to two powerful emotions. On the way up, greed is in the driver's seat. It causes people to chase returns like crazy, pushing prices to totally unsustainable heights. Then, when the cycle inevitably turns, fear grabs the wheel. It causes everyone to sell in a panic, right at the bottom. These two emotions are so incredibly powerful, they make us forget the most basic rule of gravity. What goes up must come down, and usually what goes down comes back up. It's the absolute perfect recipe for doing the one thing you should never do, buying high and selling low.
Okay, now for the most important part. What do you do with all this information? Because understanding this stuff isn't just some academic exercise. Realizing that cycles are permanent and that they're driven by our own psychology is honestly one of the most powerful advantages you can possibly have as an investor.
So here's the trap that almost everybody falls into. We take whatever's happening right now, a recent trend, and we just assume it's going to continue forever. You see housing prices going up and you think, well, they'll never come down. You see a hot stock just soaring and you think, it's going to the moon. This is called extrapolation, and believe me, it is an absolute recipe for disaster.
And this leads to a really profound, kind of counterintuitive insight. The absolute best time to argue that things will get better isn't when everyone's popping champagne corks at the peak. Nope. It's when the market is on its back, when it's in absolute shambles, when fear is everywhere, and when everyone else is panic selling their best assets at giveaway prices. That is when true opportunity is born. But seizing it, well, that takes real discipline to go against the emotional herd.
And that, right there, is the ultimate lesson. Being an experienced, successful investor isn't about finding some magic formula or being able to predict the future. It's about a deep, fundamental understanding that the cycle will never, ever end. And once you truly accept that, you can stop being a victim of the cycle's wild swings, and you can start using its rhythm to your own advantage.
So I'm going to leave you with this one question, because the headlines will come again. The experts will emerge, and they'll be armed with all sorts of new, compelling reasons why the old rules don't apply anymore. So the next time you hear them all declare that this time is different, what are you going to remember?
All right, let's dive in. Today, we're getting into one of the most powerful ideas in investing, and it comes from the brilliant Howard Marks. He argues that trying to master market cycles isn't about predicting the future. That's a total waste of time. No, it's about developing a really deep understanding of where we are right now. He says this one skill is what separates the truly great investors from everyone else.
You know, this one idea is pretty much the anchor for his entire philosophy. The details always change. One century it's tulip bulbs, then it's dot-com stocks, then maybe crypto, but the underlying script, it stays exactly the same. And why is that? Well, because the actors are always us. It's the same old human psychology. Greed, fear, envy, euphoria. These primal forces are what drive every single cycle, yesterday, today, and forever.
And this distinction right here is absolutely crucial. A cycle isn't just a random bunch of things happening. It's a chain reaction, right? It's like a domino effect. Good times, well, they breed optimism. That optimism then fuels risky lending. Risky lending, of course, eventually leads to losses. Those losses spark fear, and fear slams the brakes on lending, and that is what kills the prosperity. See, each stage doesn't just follow the last one, it's directly caused by it. If you can get that chain of causation, you're most of the way there.
So, to really bring this to life, Marx gives us this powerful metaphor, the pendulum. I want you to think of market sentiment not as some kind of straight line, but as this big, heavy weight, just swinging back and forth, constantly being pulled by the gravity of greed and fear.
This slide just nails the disconnect. I mean, in the real world, a business might have a good quarter, then a not-so-good one. Things go from pretty good to not so hot. But in the market's mind, oh, the story is way more dramatic. That exact same company's perception swings violently from flawless and unstoppable to hopeless and completely doomed. It's this emotional exaggeration, this huge gap between reality and perception that creates the crazy peaks and troughs of the cycle. And here's the key. The pendulum almost never, ever rests at that happy medium, the point of rational, fair valuation. Sure, the fundamentals, the reality of the business, they exert this kind of gravitational pull toward the center. But the sheer momentum of all that collective emotion, it's just too powerful. It overshoots the mark every single time, careening from one extreme to the other, spending almost all its time in the really dangerous territories of euphoria or despair. Okay, so let's follow that pendulum all the way to one extreme, the bottom. This is the point of maximum pessimism. It is a terrifying place for most people to be. But for the superior investor, it's something else entirely. It's the birthplace of opportunity.
Just look at how all these forces come together at the bottom. The psychology is just pure fear, capitulation. Everyone's given up. The perception of risk is infinite. Capital just evaporates as that credit window slams shut. So with no one buying and everyone desperately selling, prices crater. And it's in this perfect storm of despair that your potential future returns reach their absolute maximum.
This right here, this reveals one of the great paradoxes of investing. The moment it feels the safest to invest is actually the most dangerous. And the moment it feels the most dangerous, that's actually the safest. Why? Because at the bottom, every single piece of bad news, every fear, every worst-case scenario you can imagine has already been baked into the price. The selling is exhausted. All the risk has been squeezed out.
You know, you always hear people say, I'm not going to try to catch a falling knife, right? They want to wait for the uncertainty to clear up. But Marx's point is really stark. By the time the dust settles, the bargains are long gone. The real money, the real opportunity is in buying from the panicked sellers while the knife is still falling. If you can control your own fear when everyone else is losing their minds, you can buy assets at prices you might not see again for a generation.
Okay, so from that point of absolute maximum pessimism, the pendulum starts its long swing back. But the rise from the bottom isn't just one big event. Marx breaks it down for us as a clear three-stage psychological journey.
This framework is so simple, but it's incredibly profound. In stage 1, pessimism is still everywhere, and only a few contrarians, a few perceptive people, can even imagine a comeback. This is where the life-changing gains are made. Then you get to stage 2, where the recovery becomes obvious and most people start to get on board. And by stage 3, well, the narrative becomes euphoric. Things are just going to get better forever. And this, of course, is the point of maximum danger.
And what's pouring gasoline on this fire? Capital. The credit window, which was once bolted shut, first it kind of creaks open and then it swings wide. This flood of easy money, it's like rocket fuel. It pushes asset prices higher and higher, creating this self-reinforcing loop of good news and rising optimism.
And so, the pendulum finally reaches its opposite extreme, the top. This is the moment of maximum optimism, and therefore, it is the moment of maximum hidden risk.
I mean, look at this. It's a perfect mirror image of the bottom. The psychology is pure euphoria. The perception of risk, it's basically zero. The credit window is wide open, financing even the absolute worst ideas. Prices are at their peak, which means the potential for any future returns is at its absolute minimum. This is not a time to celebrate. This is the moment the market is at its most fragile.
This quote, this has a universe of wisdom in it. Think about it. When everyone believes there's no risk, they'll take any risk for even the tiniest potential return. Being cautious is laughed at. So the absence of fear becomes the single biggest reason to be afraid. A market's stability actually depends on a healthy dose of skepticism. When that disappears, the whole thing is basically built on sand.
And what's the rallying cry for this collective delusion? It's almost always these 4 words. It's different this time. This is the mantra people use to justify insane valuations. They argue that some new technology, some new paradigm has permanently changed the rules of the game. But as Marx warns us, this is the sound the market makes just before the floor completely gives way.
Okay, this table right here, this is the whole thing in a nutshell. Look at that perfect inversion between the top and the bottom on every single metric. But the most important line, the one you have to burn into your brain, is the last one. Perceived risk and actual risk are opposites. When everyone feels risk is high, actual risk is low. When everyone feels risk is non-existent, actual risk is at its absolute peak. If you can truly internalize this one single insight, you're building the foundation for superior investing.
So what do we do with all this? What's the takeaway? Well, the goal is not to perfectly predict the exact top or the exact bottom. That's a loser's game. Nobody can do it. The goal is something much more practical, to simply know where we stand.
You don't need a crystal ball. You need a thermometer. You just need to take the temperature of the market's mood. Are investors euphoric right now, or are they terrified? Is news met with healthy skepticism or just blind belief? Is capital easy to get, or is it impossible? By answering these kinds of questions, we can get a really strong sense of where that pendulum is in its swing.
And the key action is to calibrate. Look, this isn't about being all in or all out. It's not an on-off switch. It's about tilting your portfolio, turning a dial. When your assessment tells you that fear is high and prices are low, you tilt your portfolio toward aggression. And when euphoria is everywhere and prices are sky high, you tilt it back toward defense. You just gently lean against the wind. Sir John Templeton's famous words just capture the essence of this strategy perfectly. I mean, the logic is incredibly simple, but actually doing it, that's profoundly difficult. It requires you to fight your own gut instincts and fight the overwhelming psychological pressure from the crowd. It requires, as he said, true fortitude.
So this is what the superior investor looks like. They don't just react to the news. They analyze the market's reaction to the news to figure out the psychology. They stay disciplined when everyone else is getting emotional. They are cautious when others are reckless, and they get aggressive when others are frozen in fear. They become the buyer of last resort when the crowd is panicking, and the seller of assets when the crowd is euphoric.
And that really brings us to the ultimate conclusion here. Cycles aren't some kind of market flaw that we can regulate or engineer away. They are a permanent feature of the financial landscape because they are rooted in permanent human nature. As long as people swing between greed and fear, they are going to push things to excess. And because every excess eventually has to be corrected, the cycle and the opportunities it brings will be with us forever.
And so we end with the only question that truly matters. The question Howard Marks insists we have to ask ourselves constantly. We can't know where we're going, but based on the evidence, based on investor sentiment, on valuations, on the flow of credit, we can make an educated guess. So I'll leave you with this. Look around and ask yourself, do we have a good idea of where we are? You've seen it, right? The markets go up, they go down. We hear about booms, then we hear about busts. But what if there was a way to actually understand the rhythm behind all that chaos? Well, today, we're going to dive into the core ideas from legendary investor Howard Marks on how to do just that, how to master the market cycle.
You've probably heard this quote from Mark Twain, and it is the perfect place for us to start. See, the future is never going to be a perfect copy of the past, but the patterns of human behavior, the emotions that really drive the markets, they have this powerful, almost predictable echo. And getting a handle on that echo, well, that's the key to everything.
Okay, so how do we even begin to grasp these cycles? We need a really good mental model, and Howard Marks gives us the perfect one. The market as a pendulum.
I want you to picture a pendulum, like in a grandfather clock. It's hanging from a single point. Now, that point it's hanging from, that's like the long-term growth trend of the market. It generally goes up and to the right over time. But the pendulum itself, it is never, ever still. It's always swinging back and forth, from one extreme to the other. That swing, that's the market cycle.
Now think about where that pendulum spent its time. It's always passing through the middle, right? That's what we could call the happy medium, or fair value. But here's the thing, it never actually stops there. It's always heading towards the extremes. Extreme optimism on one side, extreme pessimism on the other. And it's way out there at those extremes where most investors get into a world of trouble. But it's also where the biggest opportunities are found.
And this is the absolute key takeaway right here. Trying to predict exactly when the pendulum will hit its highest point or its lowest point, that's a fool's game. It's just not possible, because these cycles aren't regular like a clock. But that's okay. We don't need to predict. We just need to prepare. And that all starts with understanding what's pushing the pendulum in the first place.
So, if the market really is a pendulum, what's the invisible force that's pushing it from one side to the other? It's not just spreadsheets and economic data. It's us.
That's right. The real engine of the market cycle is human psychology. It's our collective hopes, our collective fears, and all our irrational moments that create these massive swings from euphoria all the way down to depression. The economic fundamentals might be the anchor, sure, but it's our emotions that create all the momentum.
And at its core, this engine really just runs on two types of fuel, greed and fear. Greed is that little voice that convinces us that prices can only go up, that this time it's different, leading us to buy at any price. And fear? Fear is the voice that screams the world is ending, causing mass panic and selling right when things are at their absolute cheapest. They are just two sides of the same very powerful psychological coin. But, greed and fear aren't just simple on-off switches. They show up across a whole spectrum of emotions. A cycle might start with just a little bit of optimism. That optimism then builds into excitement, and that excitement can blow off into pure, unadulterated euphoria right at the top. Then, on the way down, that feeling turns into anxiety, then skepticism, then outright panic, until it finally bottoms out in a deep depression. Being able to recognize where we are on this emotional spectrum, that is a huge advantage.
And this quote from John Kenneth Galbraith just nails why that euphoria stage is so dangerous. When you see your friends, your neighbors, maybe your brother-in-law getting rich and it seems easy, your rational brain just kind of shuts down. The fear of missing out becomes almost unbearable. This is the psychological trap that fuels that final, craziest phase of a bull market.
That very human impulse that Galbraith was talking about, that fear of being left behind, is exactly what inflates market bubbles until they pop. And this isn't just some abstract theory. It's a story that has played out over and over and over again throughout history. So let's look at the real-world consequences of this collective madness.
The names change, the assets change, but the story is always the same. You look at the South Sea bubble way back in the 1700s, you fast forward to the dot-com mania at the turn of this century, and then of course, the housing-fueled global financial crisis. Every single one was a classic swing of the pendulum, driven by this massive wave of belief that, eventually, came crashing down.
And you know what you hear at the absolute peak of every single one of these cycles? This exact phrase. It's different this time. People convince themselves that some new technology or a new economic paradigm has made all the old rules of valuation totally obsolete. When you start hearing this phrase everywhere, it is the ultimate warning sign that the pendulum is swung way too far into crazy town. So how does a bull market actually unfold? Well, it usually happens in 3 stages. First, you have a few really smart, maybe contrarian people who start to believe things will get better when everyone else is pessimistic. Then, in stage 2, most investors start to catch on that, hey, things are actually improving. And finally, stage 3, that's when everyone, and I mean everyone, piles in, completely convinced the good times are here to stay forever. That third stage is where the biggest mistakes are always made.
In the bear market, it's pretty much a perfect mirror image. It starts when a few thoughtful investors realize that, you know what, this boom can't last forever. Then, as the data starts to look bad, the majority starts selling. And that final stage? It's a phase called capitulation. It's when everyone throws in the towel, totally convinced the pain will never, ever stop. And the great irony is that this point of maximum pessimism is almost always the point of maximum opportunity.
Okay, so we've diagnosed the problem, right? We get the pendulum, we get the psychology, we've seen the historical patterns. But what do we actually do with all this knowledge? How do we turn this into a real, tangible advantage? This is the million-dollar question, isn't it? If the herd is stampeding towards a cliff, how do you not only avoid going over with them, but maybe even profit from their mistake? Well, the answer isn't a stock tip. It's about fundamentally changing the way you think. Howard Marks has a name for this. He calls it second-level thinking. It's all about refusing to stop at the simple, obvious, surface-level conclusion. It means you have to go deeper. You have to ask, and then what? It's about thinking through the consequences of the consequences, and maybe most importantly, thinking about what everyone else is thinking. Let's make this super concrete. First-level thinking says, hey, this is a great company, let's buy the stock. It's simple, it's straightforward, and it's what most people do. But second-level thinking says, okay, yes, it's a great company, but everybody knows it's a great company. So all that optimism is probably already reflected in the price, which makes it expensive. The expectations are so high now that any tiny disappointment could cause a crash. See the difference? It's about seeing the layers that other people miss.
So you see what happens here? This kind of thinking, this second-level thinking, it naturally leads you to be a contrarian. It means being skeptical when everyone else is giddy and euphoric, and it means being brave and constructively optimistic when everyone else is absolutely terrified. You have to be willing to look wrong in the short term to be right in the long term.
All right, this brings us to the final and honestly the most practical part of our explainer today. How do we take all of this, the pendulum, the psychology, the second-level thinking, and put it together into a real strategy?
We have to come back to this core mantra. You can't predict, but you can prepare. You should stop trying to predict when it's going to rain and instead just focus on building a really good arc. The goal is not to perfectly time the top or the bottom of the market. The real goal is just to have a good sense of where we are in the cycle and then position ourselves accordingly.
So what does that look like in practice?
It's actually pretty simple, but that doesn't mean it's easy. When fear is everywhere, when people are terrified of risk and assets are on sale, that is the time to be aggressive. And on the flip side, when greed is the dominant emotion, when nobody seems to care about risk and prices are sky high, that's the time to pull back and be defensive. At the end of the day, it's all about tilting the odds in your favor over and over again.
So let's end with this one thought. Don't waste your time or your energy trying to guess where the pendulum is going to be a year from now. Instead, use this framework we've talked about to make an honest assessment of today. Look around. Is the crowd greedy or is it fearful? Are prices reflecting wild euphoria or deep depression? The most powerful question you can ask yourself isn't what's going to happen next, but simply, where are we now?